Yes. So this is basically a rapid revision class. So we have to revise as much as possible in the limited amount of time. So that would be our objective. And we have prepared some separate slides also for rapid revision. Few which I will share with you after the class. Okay, so these are specifically prepared for rapid revision only. Okay. Uh, since it is for prelims, we have to mainly focus on most important areas. It's very important that we identify like from where questions are going to come. That is very important. And conceptual clarity is one aspect, which of course we cannot build too much of conceptual clarity in the rapid revision class. If you know something, or if there are some gaps, we can fill these gaps. Basically, rapid revision will help filling the gap, number one. And number two, any current affairs related areas. Of course, current affairs, economic survey and budget, we will include. Not the whole current affairs, it becomes difficult in this limited period of time, but economic survey and budget, whatever is useful as far as those topics are concerned, we'll do it in the format of questions. So we'll have some questions and through that question, we'll complete the economic survey. Okay, so this is what we will be doing. Okay, so the first topic we will start is about money and money supply. Many have doubts, but in prelims basically, there were many questions asked earlier, like what is legal tender? Okay, so what is legal tender? What is fiat money? Okay, and these kind of questions are asked generally. Okay, so that becomes important for UPSC. Okay, so here, when I use the word money here, so first of all, we all know there was barter system, and in barter system, it was mainly related to exchange of commodities, etc. But the problem with respect to barter system, double coincidence of wants. It is difficult to find somebody who needs your product. Okay, so and then it is also the problem is difficult to carry forward wealth. You're working hard, you can't carry forward your wealth. And at the same time, there is an absence of standard unit of account. You don't have a standard unit of account. So this is also one more challenge of barter system. So subsequently, we have moved into a concept called as money. So when I use the word money, the different types of money, one is the full-bodied money. So full-bodied money means money whose value, face value is equivalent to the intrinsic value. So the metal value and the face value of the money, both are equal. For example, when we talk about gold currency, so the value of gold and the value of the money, both are equal. That is called as the full-bodied money. Okay, today we are not using this full-bodied money. Today what we are using is a token money. So when I use the word token money, what is a token money? Money value will be greater than the commodity value. Okay, suppose you have a coin, the coin value is just 20 paisa maybe, but the face value of the coin is 5 rupees. So here what we observe, money value is greater than commodity value. So in token money, there is no backup required with respect to any asset. You need not back it up with gold or something. Okay, so these are called as token monies. And then when we talk about representative full-bodied money. So representative full-bodied money means here basically we call it as convertible and non-convertible. That means central banks issue currency. When they are issuing currency, if they are backing up with gold, okay, and backing up with something else. So whenever you want to convert it, you go give the money and get gold. So that is called as convertible money. When I say non-convertible, today it is non-convertible obviously. So non-convertible means you can't take the money and go to the central bank and get the gold in return. This is basically non-convertible money. Okay, so convertible, non-convertible. This is what is representative full-bodied money. So they will not ask representative full-bodied money. What they can ask can be, one is, what is token money? So generally, so token money, how is token money different from basically a full-bodied money? So token money, full-bodied money means there is a backup with respect to something like a gold, etc. And that is basically the full-bodied money. And generally you will find the money value is same as the commodity value. Okay, and token money, money value is more than the commodity value. Today what we follow is token money only. Okay, now convertible money, non-convertible. So today it is token and non-convertible. Token money and non-convertible. Basically, there's nothing like you're backing it, and there's nothing like they will exchange gold with something else. Okay, and then when we use the word fiat money, so money is accepted based on the order. By fiat means by order of the government. So by the order of the government, okay, it can be RBI and government. Fiat, or that you are accepting it as a money, that is called as fiat money. But that does not mean there is legal obligation. Fiat money need not have a legal obligation that I should accept it. For example, dollars. Dollars are basically fiat money backed by US government basically. But dollar is not a legal tender in India. Legal tender means you are obligated to accept it. Fiat money, there is no obligation to accept it. There is no guaranteedly you can reject it. Fiat money, by order it is money. By order of the government, you are treating it as money. But there is no legal obligation to accept it. That is what is fiat. So that is the basic difference between fiat and legal tender. So something has to be a legal tender. First it has to be fiat. But legal, there is a difference. Legal tender means by obligation. There is an obligation that you have to accept it. When I say legal tender, compulsory to accept this type of money for the settlement of any monetary obligation. Suppose I take an auto or a rickshaw from here to the metro station. Okay, then I am giving the cash to the auto driver. Okay, and the auto driver has to accept it. Okay, so here what we have to observe is legal tender means there is an obligation compulsory to accept the type of money for the settlement of any monetary obligation, even with respect to loans, credit, whatever it is, acceptance. Okay, so that is the difference between fiat and legal tender. That is, observe the minor difference. They can ask in UPSC prelim, fiat and legal. And then, of course, checks. When I use the word check, check is not a legal tender. Checks are never legal tender. Okay, so checks are never legal tenders. Why checks are never legal tenders? Is checks are never legal tenders because check acceptance is based on trust only. So there are two parties, and with these two parties there is this discussion that goes on, and they accept, and when there is trust they accept it. So checks are never legal tenders. So based on trust between two parties, any money is accepted, any instrument is accepted. Such a kind of entity is called as fiduciary money. Fiduciary. So when I say fiduciary, checks are fiduciary monies based on trust. Check is not a legal tender. I can deny a check. Somebody is giving a check, I can say I don't want it. So this is the basic difference. Okay. Now when we talk about legal tenders also, what we have to understand is one is unlimited legal tender. Notes, when I say notes, rupee notes, have unlimited legal tenders. But coins have limited legal tenders. So both are fiat only. But one has limited legal tender, another one has unlimited legal tender. Unlimited. Okay, so here when I say limited legal tender example is coins. For example, 50 paisa coins, you cannot accept beyond 10 rupees. So there is a beyond 10 rupees I can say I will not accept your 50 paisa coins. That means the legal tender aspect is limited when it comes to coins, and therefore coins are called as limited legal tenders. That is what we should remember. 1 rupee coins above 1000 rupees I can say no, because Coins Act basically, and you all should be knowing that the 1 rupee note and coins are issued by the government, but they are circulated again by RBI. Since this 1 rupee note and coins are circulated again by RBI, these entities, 1 rupee note and coins, will fall under the assets of RBI. So tomorrow there can be a question in exam asking what are the liabilities of RBI. So, and what are the assets of RBI. So when I say liabilities of RBI, whatever RBI is issuing, vault cash. Okay, vault cash is anything above CRR which is maintained in the banks. You know, CRR is not counted generally in the vault cash, VAULT, we call it as vault cash. So that vault cash which is maintained above the CRR, which is there in the bank, it is nothing but the liability of RBI. Cash maintained in the banks is all liabilities of RBI. Okay, so even including CRR, of course, this is money. That means here, when I say legal tender or something, there is a legal obligation there, obligation. Okay, so assets and liabilities, all notes issued by RBI, all currency issued by RBI, so basically will be a liability of RBI, because RBI it's a kind of a promissory note. See, today 1 rupee note, why, somebody may ask, like, why only 1 rupee note is issued by government? Okay, so what is the significance of 1 rupee note? Why not others? Okay, so here, logically speaking, 1 rupee note is only the token money. Okay, it is the token money. Rest of all currencies are like promissory notes. Why are we calling it as promissory note? They are promissory notes because RBI says, I promise to pay the bearer the amount that is mentioned. So I promise to pay the bearer means it's the liability of RBI. 1 rupee note, you will not find, I promise to pay the bearer. So liability of 1 rupee note is not with RBI. So 1 rupee note and coins are not liabilities of RBI. But 1 rupee note and coins, RBI takes them, purchases them, and RBI is circulating them, though it is issued by the finance ministry. And therefore they go and sit on the asset side of the RBI. So 1 rupee note and all other than 1 rupee note, and coins which are issued, they are all part of the liabilities of RBI. Vault cash and all this is part of liabilities of RBI. So this much you should know. So when we talk about money supply in the economy, so there are different measures of measuring money supply. So measures of measuring money supply. So one is, we use the word called as broad money. Another one is narrow money. So narrow money means quantity wise it is less narrow. Okay. And broad means quantity wise it is more. That's all. So broad, more. Okay. Narrow means small. So here if you see M1, M2, M3, M4, we've written here M1, M2, M3 and M4. Okay, if you make an observation, okay, make an observation there, M1, M2, M3 and M4, and move away from the slide. You just make an observation there, M1, M2, M3, M4. So M1 is basically called as the narrow money. M1 is basically called as the narrow money, and M3 we call it as the broad money. Okay, narrow money is the maximum liquidity. That means if I have to arrange in terms of liquidity, so in this, if I have to arrange, the most liquid obviously will be M1. So most liquid is M1. Okay, M1 followed by M2, second liquid, M3 and then M4. So that is the order of liquidity. So order of liquidity, M1 is the most liquid, then followed by M2, then M3 and then M4. So that is the order of liquidity. Okay, but when I say in terms of quantity, M4 is maximum. Okay, so here based on this observation here, so M1 most liquid, and it is also called as the narrow money. M3 broad money. This is what we have to remember. Okay, so here CU is what? Currency and coins held. Currency and coins held. Okay, so here currency and coins both. So currency and coins in hands of the public, that is what is CU here. Okay, so obviously then the formula, if you have to understand the formula from this box itself, so M1 is equal to currency and coins in the hands of public, that is CU, plus demand deposits of the banks. Okay, so demand deposits of the banks. Okay, so demand deposits in the bank, in the commercial bank. Okay, so this is what? So demand deposits of public basically. So here other bank deposits will not be there. So we all know about NDTL. In NDTL we do not have, when I say NDTL is something like the total deposits minus other banks' deposits with banks. So other banks' deposits are not part of money supply. Other bank deposits are not part of money supply. So that you should remember. Okay, that's very important. So currency in circulation plus demand deposits of the bank. That's all. Bank only. There is nothing like term deposits of bank. See the cross mark there. Post office, demand deposit, post office, nothing is there. Okay, then M2, we have currency in circulation. That is currency and coins in the hand of the public. That is CU. Plus we have demand deposits of the bank. Plus we have demand deposits of the post offices. Observe this. Very important. Okay. So here M2 is equal to, I can write it as M1 plus the savings deposits or the demand deposits, savings deposits of post office. That is what is M2. Okay, you can see the box. Very important. Okay, then M3 you can see we have both demand as well as term deposits of the banking system. Demand as well as term deposits of the banking system. M3 is nothing but the broad money. So M3 is equal to, we can see CU plus, so here we can write M3 is equal to M1 plus term deposits of the banks. M3 is equal to M1 plus term deposits of the banks. And M4 is nothing but M3 plus total deposits. It includes everything now. M3 plus total deposits of post office. Total deposits of post office. Okay. Total deposits. So these are M1, M2, M3 are measures. How RBI measures money supply. Measures of money supply. So these are monetary aggregates, measures of money supply. Somebody is asking what are these M1, M2. So these are measures of money supply. M1, M2, M3 and M4. Okay. So, so broad money, M3 is broad, M1 is basically narrow. Broad money, these are measurements only, RBI measures. So when I say money supply, it is basically M3 currently, broad, because it includes both currency in hands of public, okay, so plus demand deposits plus the term deposits with the bank. Okay, so then money multiplier, should be knowing this concept. Money multiplier can be written as 1 by legal reserve ratio. Money multiplier is 1 by legal reserve ratio. We have discussed already this in the class in detail, but here in the rapid revision, only the formula 1 by legal reserve ratio. So legal reserve ratio means CRR and SLR, whatever you are putting it aside. So 1 divided by legal reserve ratio, or it can be M3 by M0. So money multiplier can be, you can see in the exam, M3 by M0, or it can be M3 by M0, or it can be M3 by M0, or it can be something like 1 by legal reserve ratio. M0 is basically high-powered money. High-powered money. The total liabilities of RBI, whatever RBI is issued. So the total liability of RBI. Currency in circulation plus total deposits plus the other deposits with RBI. All that put together. So when I say money multiplier, either it is 1 by the legal reserve ratio or M3 by M0. Okay. Now, similarly, there are other ratios here. Okay, so here most liquid M1, most liquid is M1, least liquid M4. But broad money is M3, broad money is M3. Okay, so if I have to arrange them in the order of liquidity, M1 is more liquid than M2, then M3, then M4. This is the order of liquidity. That's it. Okay. Now, there are other ratios like the currency deposit ratio. Currency deposit ratio. Okay, so what is this currency deposit ratio? It is the currency held by public. Currency held by public divided by deposits of public in banks. Deposits of public in banks. Okay, so that means currency deposit ratio, whatever money people have, okay, suppose let's say they are getting 100 rupees, public is getting 100 rupees, let's say if they are 50 rupees they are holding in hand, okay, and 50 rupees they are putting it in the bank. This is what is the currency deposit ratio. Okay, here currency deposit ratio is 1. Okay, so it is currency that is held by public to the total deposits of public in the banks. How much they are holding in the hand, how much they are putting in the, yes, how much they are putting in the banks. So this should be clear. Okay, so when we talk about banking, okay, there are some terms like when we talk about ratio, this is the currency deposit ratio. Okay, similarly, we have other ratios like CRR, SLR. I'll come to that, which you should be knowing already. But there are other ratios like slippage ratios. Okay, so you should be knowing what is the slippage ratio. No, slippage ratio, this is something related to NPAs, non-performing assets. So when you're measuring the banks, basically, in the current affairs, there was this discussion that slippage ratios have come down in the recent past. Okay, so in the recent past, it has come down. Okay, so M0 is high-powered money. Whatever money RBI is issuing, that is what is M0. High-powered money. High-powered money. Or M0 is the total liabilities of RBI. Total liabilities of RBI. Okay, so whatever RBI is issuing. Okay, so that is basically M0 is not money supply. Based on M0 only, that is the base money. You call it as the base money. Okay, so that's all. We can't go beyond that in this discussion here. So M0 is the base money, or you call it as the high-powered money. Okay, now see, moving forward, when I say slippage ratio, see, anywhere you have a doubt, you put a cross mark, and again, when you're revising, again, you revise this area back again. Like, okay, so that is the best way. So here, our benefit will be there when we can cover maximum possible here. Okay, so any doubt, you put it aside, then we will look into it, or you will go back again and check it back again. Okay, so here, when I say slippage ratios in news basically. So economic survey was saying slippage ratios have improved. That is, NPAs have reduced according to economic survey, NPAs have reduced in the recent past, remember. Non-performing assets have come down according to economic survey. Okay, and with respect to recovery of NPAs, out of all the methods, IBC was the most successful according to economic survey. IBC is the most successful. IBC, insolvency and bankruptcy. Through that method, maximum recoveries were done. IBC most successful. And bank has improved with respect to NPAs. So NPAs last 5 years, NPAs have been continuously increasing, etc. That statement is wrong because economic services, NPAs are good now. NPAs have reduced. Banks are doing well. Banks have become sufficiently strong. Banks' capital adequacy ratios have improved. This is all according to economic survey. Capital adequacy ratios have improved. Means based on that logic, if he's saying everything has increased, etc., NPAs have increased, then that statement will be wrong. Use that logic in marking the answer there. Okay. So when I say slippage ratio, first of all, UPSC Max can ask it is related to what? It is something related to measuring NPAs. Okay, so here it deals with newly accrued NPAs. Newly accrued NPAs. In 1 year, what are the new NPAs? To the total standard assets. To the total standard assets. Total standard assets of banks. Total standard assets of banks. You know, newly. So that means before the year starts, I will check what are the total standard assets. When I say total standard assets, it is what? It is the total loans. Okay. So in the total standard assets, I will check how many have become NPA, newly accrued NPA. So if suppose last year slippage ratio is 12%. Slippage ratio is 12%. Okay. So that means out of 100 rupees worth loan, 12 rupees loan became NPA. Now next year when I am checking, before the year I check and after the end of the year I am checking, you find that the slippage ratio has become something like, let's say 15%. 15%. It means NPAs have slipped by 3%. NPAs have increased basically. NPAs have increased. Okay, so NPAs have increased. That is the meaning basically. If 12% has become 15 means NPAs have slipped. NPAs have slipped by 3%. NPAs have slipped by 3%. That is what is important here. So first of all, I don't think you will ask specifically what is slippage, but at least you will ask slippage ratio is related to what. So it is related to NPA. It measures the newly accrued NPAs to the total standard assets. So before the year, that is before April 1st, what are the total assets? Loans. After the next March 31st, April 1st to March 31st, isn't it? Financial year. After March 31st, I am checking. How many have become NPA? Now I'll check the percentage. So last year, this year, I make a comparison. If slippage ratio has increased from 12% to 15, it means our NPAs have slipped by 3 percentage points. That is what is slippage. Okay, so that should be clear. That should be clear, and it is very simple only. There should not be any problem here. Okay. So then you come across in the current affairs, basically you come across something like the Vostro account and Nostro. Okay, so these are important in the sense, of course, they may ask, you should have read it in the current affair. So it was in news. So your account in my country's bank, Vostro is your account in my country's bank. Technically, both are same only. Okay, my account, Nostro is what? My account in your country's bank. My account in your country's bank. Okay, so there can be a prelims question there because it is in news. Since it is in news, so these are technically same type of accounts. Basically, difference is only who opens the account and where. That's all. That is the basic difference. Who is opening it and where is he opening it? If an Indian bank like SBI, suppose Indian bank like SBI is there. Now SBI is basically wants to open an account in US. SBI wants to open an account in US. Okay. It will get in touch with the bank in US. It will get in touch with the bank in US. Okay. Which will open a Nostro account. So SBI account in US bank. Okay, so it is going to open an account, it will get in touch with the US bank, okay, and it will open a Nostro account, my account in your country's bank. Okay, so my account in your country's bank. Now SBI accounts are opened in US bank. So it will open a Nostro account and accept payments for SBI in dollars. It will accept payments of SBI in dollars. So you are opening an account here and you're accepting payments in dollars. So the account opened by Indian bank in US, the account opened by this SBI, okay, in US will be a Nostro account for the Indian bank. This will be a Nostro account for Indian bank. So here the account opened by the Indian bank in US, Indian bank, SBI account, that is my account in your country's bank. That is what you'll remember, Nostro. So how will you remember? You don't, if you are new to this, you have not read anything. M and N, remember M and end, MN, MN. Okay, so N, Nostro means it should start with my, M. Okay, it should start with M. Okay, so then Vostro, okay, your account basically. That's how you remember. So my account in your country's bank. That means if SBI is opening up its account in US or in a foreign bank, okay, so this account opened by the Indian bank in US will be a Nostro account for the Indian bank. It is a Nostro account for the Indian. While for US bank, that account will be considered as Vostro. For the US bank, it is a Vostro. Okay, so your account in my country's bank. No, so for him, for the US bank, it is Vostro. For SBI, for Indian bank, it is Nostro. That's all. Okay, so that much should be clear. Of course, he may ask the word basically. He may ask like what is Vostro, what is Nostro, etc. Okay, so that should be clear. Okay, so when we, so money multiplier 1 by legal reserve ratio, 1 by legal reserve ratio or M3 by M0, M3 by M0. That much you should remember. Okay. Now, then legal tender, there were questions already asked. Okay. So if you, of course, previous questions everybody would have solved. Okay. So this is a question. This is how they'll ask. This is a question they've asked. One second. Okay, like this they have asked. This is a previous question only. So, describes the meaning of legal tender. So, checks and drafts, it is not legal tender. Fiduciary. Metallic money in circulation. Okay, so that is not. Okay, money which is tendered in court of law to defray. No, the money which a creditor is under compulsion to accept in the settlement of his claims. Compulsion to accept. So like this. Of course, we don't have much time, we can't. So there was non-fungible token. Of course, some say it is SNT question. Or it's not SNT related question. It is basically SNT, or it can be cryptocurrencies. NFT is basically an extension of cryptos, but they do not have a unique value. Suppose my UPSC notes I can convert into NFT and sell it in the market. Okay, so these are called as non-fungible tokens. So this was in news, therefore they have asked this. Okay, so earlier they have asked interest coverage ratio. Of course, they have not asked slippage ratio. I've discussed slippage ratio. So they've asked this interest coverage ratio. So interest coverage ratio is checked by the firms. Checked for the firms. Banks will check this interest coverage ratio and then they will give loans. Okay, so whether the firm is doing well or not, check the question. That's the reason I've moved aside. You just check. So they will this interest coverage ratio will tell whether that particular firm is stable enough to cover its interests. Okay, whether its profits are sufficient enough to cover its interest. Okay, to cover its interest. Okay, so that is whether the profits which the company is getting, is it sufficient enough to cover its interest? So that is what they do. That is what is interest coverage ratio. Suppose interest coverage ratio is 2.5. It means that company has the profits of the company can cover the interest 2.5 times. Okay, very good companies can have interest coverage ratios of 10. Okay, so why? That means it can, through its profits, it can cover the interest 10 times, interest 10 times. But if it cannot cover, then it's a problem. So the higher the borrowing firm's level of interest, the worse. No, see the third statement, it is wrong. So if the interest coverage ratio is more, means you have more profits to cover the interest. Okay, more profits to cover. That means if you are covering your interest 2.5 times, okay, or 10 times, means it is better. So the third statement is wrong basically. So for this question, answer is 1 and 2. Okay, so present risk of the firm as well as the future risk of the firm can be understood. So that is what is the interest coverage ratio. Okay, so like this, on ratios alone, they can ask some question in the exam. So on these ratios itself, they can ask some questions. So, some ratios we will see. And remember, no technical questions will be asked when it comes to NPAs, etc. So you need not worry. Array Basel 3 have not understood everything. But UPSC, that is only for understanding only. Nobody will ask Basel 3 completely. Basel 3, the difficult parts of Basel 3 will not be asked. Okay, so moving forward now, since you have understood this, there are some more ratios which we can discuss, which are important for exam. Okay, so in the monetary policy, so we said money supply. So in this money supply, RBI uses different tools. One is RBI uses quantitative tools to handle this money supply, and RBI also uses qualitative tools to handle the money supply. So in this quantitative tools, the most important is LAF. LAF, the gap between, it is nothing but repo and reverse repo. Okay, or we have the MSF, or we have the bank rate, and we have OMO, open market operations. We have operation twist, or we have long-term repo operations, LTROs. Okay, and then we have standing deposit facility, which is recently in news. Okay, so all these are quantitative tools. Or we have the reserve requirements, like the CRR and SLR. Okay, so nowadays these questions only something that is there in news only should come, because nobody will ask now, no, what repo rate has reduced, what will happen to money supply, reverse repo increase, decrease, what will happen? Nobody will ask that. Okay, so nobody is going to ask these questions like, okay, so repo, reverse repo, they'll not ask. But what can be the question? One question can be standing deposit facility. First of all, now this is how it is. Here we have MSF, the upper end, marginal standing facility at 6.75. Okay, and then we have the repo, let's say, the repo at 6.5. Okay, and then we have SDF, the standing deposit facility at 6.25. Okay, and then at the bottom, we have the fixed reverse repo, which is not used much. Fixed reverse repo, this is at 3.35. This is not changed since many years. Okay, so last 1-2 years, 3.35. Remember, RBI is not using this fixed reverse repo much. Not using the fixed reverse repo much. Okay, around 2 lakh crores only RBI has decided to borrow from banks or take from banks up to 2 lakh crores only. There is a limit. Okay, so now they are more dependent on SDF. SDF is standing deposit facility. So what is this SDF? Very important. SDF also, you have banks and RBI. Now banks are putting money into RBI. Banks are putting money into RBI. So reverse repo, RBI should put G-Secs. This is how the reverse repo works. But in SDF, these G-Secs are not required. Without the facility of G-Secs, without RBI parking G-Secs with banks, banks can keep their money with RBI. So tomorrow question comes up, what is the question? The question can be something like, the excess liquidity in the banking system can be absorbed through SDF. That is true. Excess liquidity. Banks have a lot of money, so that money can be absorbed without the obligation, most important, without the obligation of G-Secs. RBI need not put G-Secs. That is what is SDF. And one more important observation is, whatever SDF amount which banks are putting, that is, this bank is putting let's say 5 crores. This amount is also tallied under the SLR target. SDF, whatever is maintained, is tallied under SLR target. Suppose SLR has to be maintained around 18% SLR. So this 5 crore which bank is putting in RBI will be part of the SLR target. It is not part of the CRR. It is not part of the CRR target. It is part of the SLR target. So this area there can be a question. Another important aspect is, earlier the gap between the fixed reverse repo, or the reverse repo and MSF, the upper end, the gap between reverse repo and MSF was called as the corridor. Corridor is the gap. So since now fixed reverse repo is not used much. So now the corridor, when I say corridor, now it is generally SDF and MSF gap. SDF and MSF, that is basically you have 50 basis points now. 50 basis points or 0.50. That gap is basically called as the corridor. So he may ask from the previous context only. He may say the gap between reverse repo rate and MSF is called as the corridor. Okay, that may also be right if he's not putting updates from the latest newspaper, and he's saying, corridor is something like the gap between the reverse repo and MSF. Suppose he's not doing that, then there will be a clue in the question itself. So nowadays they are calling gap between SDF and MSF as the corridor. The corridor gap here is how much? 50 basis points, 0.50, no? 6.25 to 6.75. Observe that chart there. Okay, so that is the corridor now. Earlier corridor is the gap between the reverse repo and MSF. Okay, so now this is the corridor. Now one more observation is, what is the basic difference between repo and MSF? Now this can again, so this is one important aspect now that we have to see. So the basic difference between repo and MSF. So repo and MSF both are short term only. Repo and MSF both are short term. Both are short term. Okay. Repo is not just for the commercial banks. It is for other financial institutions, including central government and state government. But MSF facility, through MSF, only commercial banks can borrow. Only commercial banks can borrow using MSF. Another important aspect is there is no upper limit with respect to repo. No upper limit with respect to repo. That is how much ever GSEC you have, you put and borrow. But when it comes to MSF, there is an upper limit. This upper limit is about 3% of NDTL, 3% of net demand and time liability. That is the upper limit with respect to MSF. Okay, so that is one more important observation, upper limit with respect to MSF. Then another important aspect is SLR related securities cannot be pledged under repo, but SLR related securities can be pledged. SLR related securities can be pledged. SLR related securities can be pledged under MSF. SLR related securities can be pledged under MSF. SLR related securities cannot be pledged under repo. Very important. Very important. That you should remember. Okay, so this is something which you will remember. Okay, so then that's all. So here everybody knows this, no? Repo, reverse repo, okay, MSF, CRR, SLR, SDF, all these are going to increase, means money supply is going to decrease. Money supply is going to decrease. So everything it is the same, okay. And then basic difference you have understood between MSF and repo. We have also understood the difference between reverse repo and SDF. Reverse repo and SDF. Okay. Bank rate is completely different. Bank rate is long term basically. Banks are able to borrow money from RBI for a long term period. And even for bank rate, GSECs are not required. Even for bank rate, GSECs are not required. Okay. So bank rate is again different. Bank rate is again different, long term basically. They're not using this as a policy rate nowadays. Okay, so and then another important aspect which can come in the exam. So corridor is clear, and repo and reverse repo were earlier suggested based on Narasimhan committee recommendations. Narasimhan committee recommended repo, reverse repo. So 1999. So Narasimhan committee recommendations came up with repo and reverse repo. Okay. Then when we talk about this open market operations means buying and selling. RBI buying and selling GSECs. So RBI buys GSECs to inject liquidity, and RBI sells GSECs to remove liquidity from the market. This is known. So in this OMO, there was something like Operation Twist. Operation Twist, which was done by, so who did Operation Twist earlier? First it is US. US was doing Operation Twist. So Operation Twist deals with, basically the purpose of Operation Twist is making long-term loans cheaper. Long-term loans cheaper. Okay. So selling short-term bonds and buying long-term bonds simultaneously. Okay, and this will reduce inflation also. There is no inflation. Inflationary effect is also not there. Simultaneously, when you are doing both of the things together, selling short-term and buying long-term bonds simultaneously, this is what is called as Operation Twist. Okay, so now when we use the word NPA, Of course, I will give you this rapid revision document. This is for rapid revision only. Okay, so when we talk about NPA, non-performing assets, so when I use the word standard assets, okay, so standard assets, loans where borrower is repaying the principal and interest in a timely fashion. No, timely fashion, if it is giving it off, then it is basically called as a standard asset. Okay, so but RBI has come up with categorizing something like the special mention account. So special mention accounts are not NPAs. Special mention accounts are those entities before the loan becomes an NPA. Before the loan becomes an NPA. So when I say SMA 0, so up to 1 to 30 days, there is no payment of principal nor interest. Okay, so this is called as SMA 0. SMA 1, 31 to 60. Okay, and SMA 2, 61 to 90. So more than 90, okay, then it turns out, the loan turns out to become a non-performing asset. This is what we should understand. Okay, so when I say NPA, so it is crossed SMA 2. Okay, so the loan principal or interest is not paid for more than 90 days from its due date. Then such a loan is classified as non-performing asset. Okay, so when we talk about farm loans, it is basically cropping season is taken into consideration to decide whether a loan is NPA or not. Okay, so obviously many a times public sector banks have the highest NPAs. Public sector banks highest NPAs. Okay, then we have something like gross NPAs and net NPA in the economic survey. So in the economic survey, there is this word that is used called as net NPAs and gross NPA. Okay, so when I have to arrive at the net NPA, okay, so net NPA is what is finally visible on the balance sheet. So what is this net NPA is basically gross NPA minus the provisioning amount. So gross NPA minus the provisioning, whatever you have provisioned. So as per RBI norms, banks must set aside funds to cover losses against NPA. So to cover the loss against NPA, banks have to put some amount of assets aside. That is what is called as provisioning. So from the total, when I say net NPA, from the gross NPAs, when I am removing this provisioning amount, when I remove this provisioning amount, you arrive at something called as the net NPA. This they can ask in the exam because it is clearly given in the economic survey. So economic survey was talking about net NPAs and gross NPAs. So what is net NPA? It is nothing but the gross NPAs minus whatever funds, that is the provisioning, minus the provisioning. So banks, what is provisioning? As per RBI norms, banks must put aside funds to cover losses against their NPAs. Okay, so you are putting some funds aside. Out of the total gross NPA, you are removing the provisioning amount, then you arrive at something called as the net NPA. This can be asked in the exam. Okay, so that should be clear. And then when we talk about NPA, so we have substandard, doubtful and loss making. So NPAs can also be categorized into substandard, doubtful and loss making. So up to 12 months, that is 90 days to 12 months, there is no payment. Okay, so then we call it as a substandard asset. Now it stays as substandard for another 12 months. Then it is called as doubtful. So loss-making asset means, something like the auditors have understood the loss that is going to be incurred by this particular asset. Loss, that means this will not be recovered max. Okay, so such a kind of asset we are calling it as loss-making asset. So when I am saying substandard, doubtful and loss-making, all these three are categorizations of NPA. SMAs, special mention account, are basically categorizations. SMAs, special mention accounts, are categorizations of the loan before the loan becomes an NPA. So before the loan becomes an NPA, it is basically categorization, which is special mention account. After the loan becomes NPA, you have the categorization as substandard, doubtful and loss making. Okay. Now, when we talk about the Basel norms, so Basel norms basically, we have discussed Basel. It is very difficult to discuss Basel, but few things and words you will remember. So what are the Basel guidelines? So Basel Committee on Banking Supervision, BCBS, is the entity which has given something like the Basel guidelines. That is the first thing which we have to remember. And initially when it has come up with the Basel 1, it has only come up with something like the capital adequacy norms, capital adequacy. So in the Basel 1, there is only capital adequacy. So capital adequacy, suppose Basel 1 was basically introduced in 1988, it focused mainly on one risk. So when we talk about capital adequacy ratio, what is this capital adequacy ratio? It is the total capital to the risk weighted assets. Total capital to the risk weighted assets. Okay, so that is what is capital adequacy ratio. So so I'll write it on a new page for your clarity. So here, when we talk about Basel 1, so Basel 1 was only interested in the capital adequacy ratio. So when I say capital adequacy ratio, it is nothing but the total capital divided by the risk weighted assets. Okay, so there are two types of capital. One is the tier 1 capital, another one is the tier 2 capital divided by the risk weighted asset. Risk weighted asset is basically loans. So when I say tier 1 capital, this is seen as good capital or the liquid capital, liquid. This tier 2 capital is not so good capital, not so good capital. So in the tier 1 capital, good capital, we have something like the profits, that is the retained earnings or the profits. It has the main aspects like equity, paid up capital, equity, etc. So these are the part of the tier 1 capital. In the tier 2 capital, these are not so good. Preferential shares are part of tier 2 capital. So here UPSC will generally not ask basically what is there in tier 2. Okay, but at least you should know tier 1 is the good capital. So tier 2 capital is something like not so good. It has aspects like subordinate debt, not so good debt, or preferential shares, etc. These are part of tier 2 capital. So according to Basel 1 guidelines, this should be 8%. Okay, capital adequacy ratio, which will indicate the strength of the bank. UPSC previously asked this question, capital adequacy ratio is set by respective banks. No, capital adequacy ratio is fixed by RBI. So why RBI? Though that means the Basel Committee on Banking Supervision, they have come up with capital adequacy norms, capital adequacy ratio norms. RBI will say how much Indian banks have to maintain. Simple logic. According to Basel, we have to maintain 8%. But RBI in India said banks maintain a capital adequacy ratio of 9. So we are maintaining, our banks are maintaining a capital adequacy ratio of 9%. So instead of 8. So that is what we have to remember. Instead of 8, we are maintaining 9. So this is about the capital adequacy ratio and tier 1 and tier 2 capital. So one more important aspect is Basel 1 is only going to cover something like Basel 1 has to cover, or Basel 1 is only going to cover the credit risk. Only credit risk. It is not going to cover the market or operation risk. Only one type of risk is covered. So that much we have to remember. So market risk is not covered, as well as the see here. So for faster revision, in Basel 1 1988, okay, and focused entirely on one risk, that is credit risk. It defined capital and structure of risk. Capital adequacy ratio, it said 8, but India, RBI said maintain, Indian banks, you maintain 9%. And India adopted Basel 1 in 1999. Okay, so when it comes to Basel 2 guidelines, published in 2004, so much difference is not there. Here also capital adequacy ratio, they said 8 only. Okay, but here one important aspect is instead of one risk, that is the credit risk, they are maintaining, they are going to handle all the three types of risk: capital risk, market risk, operational risk. So credit, market and operational, all the three types of risk are handled. So here there is an approach called as a supervisory review, regular supervisory review. So regular supervisory review means banks have to give their details, or banks have to submit their details on a regular basis. So that is what is called as supervisory review. So banks are required to develop and implement better risk management techniques for monitoring and managing all the three types of risk. What are the three types of risk? Credit, operational, as well as market risk, all the three things. So here, Basel 2, you will remember only two words. So Basel 2, one is it covers all the three types of risk, credit plus operational plus market. This is one thing which you will remember. Yeah, credit plus operational plus market. This is one thing. All the three types of risk covered. And then second point which you will remember is supervisory review plus market discipline. Okay, so supervisory review plus market discipline. So market discipline means banks should disclose the details, how capital adequacy ratio is, okay, and how the risk exposure is. They have to regularly update it to the central bank. That is what they have to do. Supervisory review, so better management techniques so that you monitor all the three types of risk. These are the three things. Then Basel 3. Of course, Basel 3 in detail, it becomes difficult, but see here, in 2010, Basel 3 was released. Okay, so why? Because though there is Basel 2, there was financial crisis, subprime crisis. Okay, so banks, making banks even more capital intensive. This is the logic of Basel 3. Okay, so here the guidelines aim to promote a more resilient banking system on focusing on 4 vital banking parameters. Remember 4 vital banking parameters, that is capital, leverage, funding and liquidity. Capital, so here if you see capital, leverage, funding and liquidity, this 4. So you will find in the exam if you are finding like, okay, so Basel 3 focuses on 4 vital banking parameters like banking, leverage, funding and liquidity. That statement is right. Capital, leverage, funding and liquidity. That statement is going to be right. Okay, so no doubt there. So that statement is right, and that means what? There are ratios like, so Basel 3 basically, on a wider perspective, you should understand that it talks about capital. So it talks about capital. One is other than the 8% capital adequacy ratio, it also talks about capital conservation buffer plus another counter cyclical buffer. Okay, so 2.5% capital conservation buffer, 0 to 2.5% counter cyclical buffer. So overall it is 13%. According to RBI, it becomes 9 plus 5. It becomes around 14%. So with respect to capital, this is additionally, okay, capital conservation and counter cyclical buffer. Okay, and other than that, again, there is liquidity coverage ratio. Liquidity coverage. So tomorrow question comes up, liquidity coverage ratio and net stable funding ratios. These are basically given by the Basel. Okay, so liquidity coverage ratio is mainly to handle short-term bank run. Liquidity coverage ratio is mainly to handle short-term bank run. Short-term bank run. When I say short-term bank run, okay, 30 days period, how much deposits are removed generally on an average? On similar line, so much of money should be maintained in the form of liquid assets. That is what is liquidity coverage ratio. So it is basically to handle short-term stress. NSFR is basically bringing in long-term stability. Long-term. NSFR is long-term stability. Long-term stability. So, Tier 1 capital, core capital, according to Basel 1, Tier 1 capital, all put together it becomes 10.5%. That is minimum 6% should be minimum 6% should be Tier 1. Minimum 6%. Okay, so 6% should be Tier 1 capital, and again it becomes 2.5 plus 2.5, then it becomes 11. But minimum Tier 1 capital, according to Basel guidelines, minimum Tier 1 capital should be 6%. Tier 1. Okay. So, in line with this, one more word we should understand for UPSC prelims is additional Tier 1 capital. 81 bonds. So, these 81 bonds are in news. Additional Tier 1 bonds. Okay. So, additional Tier 1 bonds are a typical kind of bonds without any complete maturity period. These are everlasting bonds. Okay. Banks actually issue these bonds and raise money for enhancing their Tier 1 capital only. That is why the reason we call those bonds as 81. 81 means additional Tier 1. So, banks are issuing these bonds to maintain Tier 1 capital, and that is the reason we call them as 81 or additional Tier 1 bonds. There is no maturity period for these bonds. These are seen as everlasting, and they are highly risky because central banks can write off these bonds anytime. Write off. The returns are high, obviously. The returns will be high, no doubt about it that the returns will be high, and that is why somebody will buy, and it's for not for everybody. Somebody should be in a position to take that risk. Take that risk. Okay, so this additional Tier 1 bonds is in news, and banks are issuing these 81 bonds mainly to maintain Tier 1 capital, and somebody is buying these bonds means he will receive the interest. There is no guarantee. Suppose in between, like if the bank's capital situation is bad, maybe 1 or 2 years, bank may not pay the interest also. That is also okay. And these bonds can also be written off by the RBI or the central bank whenever it wants. Okay, so that is the reason these 81 bonds are generally seen as risky entities. Risky. Okay, so students, are you there? Yes. Yes, yes. Okay, so in news is this bond called sovereign green bonds. Okay, so additional Tier 1 bonds you should be knowing, and in news is this bond called sovereign green bonds. So remember few things about sovereign green bonds. First thing is, remember corporates also, Indian corporates have also issued green bonds. It's not that green bonds are only handled by government. So they are issued by even corporates as well. Number one. Number two, who is issuing them? Now the sovereign green bonds are issued by RBI and not SEBI. Sovereign green bonds are issued by RBI and not SEBI. You will get confused in the exam. Since it is in news, they can ask. So they are issued by RBI and not SEBI. Okay. Another important aspect is green bond, the word itself. No, word itself. They are issuing. Why are they issuing this bond? They are issuing this bond so that the money is raised for environment-related purpose. Now, these bonds do not offer higher yield. You will not get more yield. Why? Because these bonds are issued at higher price. Bonds are issued. They are issued at a higher premium. So, the last line there. See the last line I have written. These bonds are issued at a higher premium. Higher premium means when he is issuing this bond, he will charge a higher price for issuing this bond. he will charge a higher price for issuing this bond. They are issued at a higher premium. Higher price means yield will be less. Bond price, bond yield, inverse relation. They are issued at higher premium, higher price. That fellow has to follow certain rules, get some sanctions, that it is for environment friendly projects and all that is spending money, and that is the reason he will issue it at a higher premium. When the yield is less, then why is somebody buying? They will buy because tax relief is there. You are buying these bonds and all, there is tax concession, okay, all that. Okay, so that is the reason they will buy. So this is what you should remember. Okay, so this is about, one is the AT1 bonds, that is the additional tier 1 bonds, and another one is the sovereign green bond. Okay, so here you can see sovereign green bond highest issued by UK. India, of course, is a small entity when it comes to issuing sovereign green bonds. Status of sovereign green bonds issuances in 2021. You can see highest it is UK and then France. Okay, so that is something like, if at all a factual statement is going to come up. Okay, so that's all. Okay, so these are some things which we should remember. Now one question, because it's overheating, I know this this will be something like rapid revision. So one, incremental capital output ratio, we'll talk about capital output ratio. First is interest coverage ratio, which UPSC already asked. Okay, so this higher is, it's the better. Higher it is better. Okay, higher it is better. That is profit you have divided by interest to be paid for the firm. So obviously, if it is 5, means 5 times the profit can cover the interest. If it is 10 times it can cover the interest. Okay. Similarly, this is about the interest coverage ratio. Then we have discussed capital adequacy ratio, total capital to risk-weighted assets. This is related to banks, etc. Okay. Then here only we have talked about LCR, liquidity coverage ratio, short-term stress or stress conditions of the bank. Okay, LCR in the context of Basel III. Okay, NSFR, net stable funding ratio. Does the bank have stable source of funding for giving long-term loans? That is what is NSFR. Okay, so one more ratio. Then capital output ratio. Of course, this capital output ratio is not in banking. Capital output ratio is nothing but the amount of capital that is required to produce a single unit of output. Okay, so that is what is capital output ratio. Or you will find ICOR in newspapers, incremental capital output ratio. Incremental capital output ratio means what is the additional capital that is required? Additional capital required to produce a single unit of output. Additional capital required to produce a single unit of output. Okay, so that is basically when we say capital output ratios, these capital output ratio, lower is the capital output ratio, better, or it is the country is more efficient. Lower the capital output ratio, it is better. Why? The amount of capital required to produce a single unit of output. If I require less capital to produce one single unit of output, it is always better. So lower is the capital output ratio, better it is. So developed countries like US have lower capital output ratio, or they have lower incremental capital output ratios in comparison to countries like India. In India, we need more capital to produce a single unit of output. US, you need less capital to produce a single unit of output. Is that okay? So these are some ratio. Then we have discussed slippage ratio. Slippage ratio is with respect to NPAs. NPAs. Okay. Yes. Is this clear, everybody, till here? Students, you are able to revise? Okay, I think you are able to revise. It will be little difficult in the sense assimilation part, but that's how it is, revision. I hope you are able to revise and recollect things. And wherever you have a doubt, no, that area, when you're finding, oh, this area I forgot, then just make a mark, okay. Bessel 3, I have to revise again, okay. Put a mark there. Then capital output ratio. Higher capital output ratio, higher is the capital output ratio, lower is the efficiency. Or whenever we are writing, you can also write along with me, and then this notes can be revised before going to the prelims. Okay, so see, this is about, then we have seen RBI, we have seen quantitative tools. Similarly, there are some qualitative tools to handle the money supply. So, what are the different qualitative tools? You have margin requirement, to consumer credit regulation, consumer credit, rationing of credit, or we call it as credit rationing. 4, we have moral suasion, moral advice, or direct action. Okay, so these are all qualitative tools. Selective credit. Qualitative tools are also called as selective credit control. Selective credit. Selectively, I want to control the credit. Selectively, I want to increase the credit. Okay, so I think it is clear. Now, Insolvency and Bankruptcy Code was seen as one such entity which has recovered maximum NPA. Maximum NPAs have been handled by Insolvency and Bankruptcy Code, IBC. So, IBC, it's a difficult area. Difficult is, we'll only remember that there are different entities. One is you have the adjudicating authority in IBC. Adjudicating authority, you have National Company Law Tribunal, NCLT, and debt recovery tribunals. Okay, debt recovery tribunals. So individuals, etc., and partnership firms will go to DRT. Corporates and limited liability partnership companies will go to NCLT. Okay, so that is one. And then we have, one is the adjudicating authority. Then we have different types of creditors. So one is the operational creditor. Now even operational creditor can take the case, or you have the secured creditor. Okay, so operational creditor is there, and you have the secured creditor like the banks. Okay, or it can be the debtor. Anybody can take the case to the adjudicating authority now. So that is, they can take the case of NPAs to NCLT or the debt recovery tribunal, etc. So here we have, then we have the Insolvency Bankruptcy Board of India. Insolvency and Bankruptcy Board of India, which is the regulatory body which handles the IBC. Regulatory body. Okay. Then we have we have the insolvency professional. So this insolvency professional will be appointed by the adjudicating authority. Insolvency professional. So they are not small people. No? They will be taking, they are the in charge of the resolution process. So they will handle the debtors, assets, etc. These are called as insolvency professional. And insolvency professionals, some guidelines are given. These guidelines are given by insolvency professional agencies. So insolvency professional agencies, some guidelines are given. Okay, so that is what we should remember. Insolvency professional agency. Earlier, the cases have to be resolved within 180 plus 90, that is 270 days. Now it has been extended again to 330 days. So the cases can be resolved within a span of 330. So that means one is you have to resolve it, come up with an insolvency procedure, you get it done, or you dilute the company off. But anything has to be completed within a span of 330 days. For startups, it is 90 days plus another 45 days, around 135. Okay, but for other companies other than startups, it was 180 plus 90 earlier, 180 plus 90, around 270. Now it is 330. Okay, then we should also remember one word which is called as the haircuts. So haircuts has come up in news with respect to companies like Videocon, etc. So this is basically the revenue foregone, or the loan amount which you have foregone. So you are ready to accept 95% haircut or 90% haircut. That means you are able to recover less also, it's okay. This is what is haircut. Haircut is the amount which the creditor forgoes, the amount which he is foregoing for giving this, for accepting the IBC procedure, accepting. That means he is not getting the complete amount, but is ready to forego. That amount which he is able to forego, okay, the creditor is able to forego, that is what is called as haircuts. Haircuts, high haircuts means loss basically. So that is basically called as haircuts in IBC. So haircuts was in news with respect to some companies like Videocon, because 95% haircut was accepted. So 95% means 100 rupees, 95 rupees is given off, it's okay. 5 rupees is recovered also, it's okay. So that is basically called as haircuts. Okay, so economic survey says IBC is the most important entity in terms of recovery. In terms of recovery, highest recovery was done through IBC. Okay, so this is about okay. Okay, now one area where questions keep coming is, that is the cooperative banks, okay, regional rural banks, okay, what are universal commercial banks, or what is differentiated banking. Okay, so like this, there are some questions always in the exam which you should be knowing. Okay, so when we talk about a bank, basically, bank is a financial institution which performs the core functions, that is accepting deposits and giving loans. So when we talk about Indian banks, okay, so one is we have the scheduled banks and the non-scheduled. So when I say a scheduled banks are those banks which are registered under the second schedule of RBI Act 1934, and they have a minimum paid up capital of 5 lakhs, and welfare of customers is one of the important objectives of a scheduled commercial bank. So today whatever banks we see are mostly scheduled banks. So there again we have the commercial banks. So here when I say scheduled commercial bank, we can see RRB also here. So RRB is also a scheduled commercial bank. That is the observation from this chart. RRB is also a scheduled commercial bank. Okay, and then we also have the cooperative banks. So cooperative banks are different from commercial bank. Cooperative banks are different from the commercial bank. Okay. Okay, so scheduled commercial banks are banks which are included in the second schedule of RBI Act 1934. Okay, and the major difference between the scheduled commercial banks and the scheduled cooperative banks is their holding pattern. Holding pattern. So the owners are the borrowers basically in cooperative banks. Okay, so basically when we talk about SBI, the bank got birth during the British era. Okay, so its first parents were three presidency banks: Bank of Kolkata, Bank of Bombay, and Bank of Madras. Now in 1921, these three presidency banks were merged into Imperial Bank of India. These three were merged into Imperial Bank of India. And this Imperial Bank of India was nationalized in 1955, and it is renamed as State Bank of India. Renamed as State Bank of India. Okay. So it is renamed as State Bank of India. See, some terms will not be covered in class. Some terms are not covered in class, obviously. Some student has put a message, some topics are not. Some terms are not covered. See, for example, when I use the word haircut, so haircut is in newspapers basically. Okay, so it's not that whatever we discussed in class only will be discussed here. For example, sovereign green bond is in newspaper. Okay, so recently it was in news. Okay, and something that is there, maybe in the economic survey, there are so many chapters. All that cannot be covered in our regular class, no. So whatever is important from there, I'm picking it up here, that's all. So that's not like a topic or a separate area altogether. So in the banking part, when we are discussing about SBI, some facts are important. So whatever is important, we are trying to put them here. Okay, so here 1921, these three presidency banks were merged. I know that most of you wouldn't have read the current affairs of economics last, and I also know that most of you wouldn't have read the economic survey completely or the budget completely. So in economics, basically, along with new stats, new concepts will be added every year. New concepts only will come. Okay, so new concepts will get added. Okay, so these three presidency banks were merged in one entity called as the Imperial Bank. This Imperial Bank was nationalized and was renamed as State Bank. I gave you a detailed document of the banks related, but this is basically a shortcut document for revising at a faster pace. It's a shortcut document. Okay, so they may ask SBI was nationalized in 1955. Maybe one statement in the exam. Haircut is nothing but the loan foregone for accepting the insolvency procedure. So you're a creditor, you gave loan, 100 rupees loan, but they said we will be able to recover only 90 rupees, etc. So then he said, that means you have 90 rupees. Or he said, you forego 90 rupees and you will only get 10. So haircut is 90% there. So that means you are only getting 10 rupees means haircut is 90%. So this is what is called as haircut. That is the loan foregone for the IBC procedure. So whatever loan you would have given, complete money may not be recovered. So that is basically called as haircuts. Some haircuts are high. Some haircuts were high during COVID period when you're trying to recover money. Haircuts were high. Videocon was given 95% haircut. That is the reason this haircut came in news. 95% haircut means, okay, whatever loan this fellow has taken, no, 95% is not going to pay it back. Okay. So 1955, India nationalized Imperial Bank of India. It formed the State Bank of India. And then 1969, 14 banks were nationalized, and 1980, another 6, which we know already. So another 6, basics class also. Okay, and the purpose of nationalization is financial inclusion, confidence of publics, banks will become more sustainable, putting up branches in the remote corners, all that. But of course, nationalization did not lead to whatever we wanted to achieve. And that is the reason there came up a need for RRBs. RRBs, regional rural banks. So regional rural banks have been set up, basically. RRBs have been set up. RRBs were set up because the objective of nationalization could not be reached. And therefore, in mid-70s, they decided that you need some other entities which can help. So, RRBs were established basically on the provisions of Narsimhan Group recommendations, and 1976 RRB Act was the main entity that was responsible for setting up RRBs basically. So Narsimhan Working Group, you can see here. Okay, so RRB basically, RRBs were established under the provisions of an ordinance in September 1975 and RRB Act 1976 to provide sufficient banking and credit facility to agriculture and rural sectors. So that is the objective. Agriculture and rural sectors basically. That is the objective they have come up with RRBs. And RRBs, regional rural banks, are also seen as part of scheduled commercial banks. Scheduled commercial banks. Okay, and they provide banking facilities to rural and semi-urban areas. Banking facilities to rural and semi-urban areas. So here operations of disbursement of wages, MGNR, EGS, etc., all that. Okay. Now, RRBs are local level organizations operating in different states. So, they have been primarily created to serve rural areas of India with basic banking and financial services. Basic banking and financial services. Okay. So, here if we see some of the basic differences between RRB and other banks. Okay, so just observe this. This is a graph so that you will remember and not forget. Okay, just see this. Universal Commercial Bank, Banking Regulation Act, they are also regulated under Banking Regulation Act. RRBs are also regulated under Banking Regulation Act. Along with that, along with Banking Regulation Act, you have RRB Act 1976. Okay, so then comes CRR, SLR, MSF. They are applicable to regular Universal Commercial Bank, and RRBs also have to maintain CRR and SLR. Remember this, RRBs also have to maintain. Now, universal banks, they maintain a PSL target of 40%. Priority sector lending target for the regular banks is 40%, but RRBs have to maintain a priority sector lending target of 75%. Okay. Now, lending rates are decided by banks only. Okay. So, but RRBs, there are some regulations, etc. Okay. Now, one more important aspect here. Okay. So, regulation part only RBI is regulating the other banks. But RBI plus NABARD, all are regulating here. RBI plus NABARD. Okay, so this is how you will read RRB. At the end, you can't read complete document. No, you can't read the complete document. Oh, regional rural banks. For example, I'll show you our complete document also. This is for a faster track. You will observe, oh, CRR, SLR, they have to maintain. Yes, RRBs also have to maintain. PSL target restriction for RRB is 75%. Unlike regular banks, it is 40%. Okay. Then we have the regulator here, universal banks, all banks, these are RBI. And then here it is RBI plus NABARD. Okay, so that basic observation. Okay, so should be there. So this is something like the long document. So revising from a long document becomes tiring in a revision class. Nobody can revise from a long document, becomes difficult. Okay, so like this, you should know the difference between RRB and regular banks. Similarly, we should also know the difference between banks and NBFC. So banks and NBFC, both of them are regulated by RBI only. Okay, banks accept both demand deposits as well as term deposits. In NBFC, non-banking financial companies, NBFCs, there are two types of NBFC. One is called as the deposit-taking NBFC, which is NBFC-D. Look into the chart. Another one is NBFC-ND, non-deposit-taking NBFC. Okay, both these entities give loans. But when we talk about deposit-taking NBFCs also, these deposit-taking NBFCs also will only accept term deposits. They will not accept demand deposits. They will not accept demand deposits. Banks maintain SLR and CRR. NBFCs do not maintain SLR and CRR. Okay, banks, there is deposit insurance facility that is available. Deposit insurance facility that is available. For NBFC, there is no deposit insurance facility. You put money in NBFC also, there is no deposit insurance facility. Okay, so that is the basic difference between NBFC and a bank. So we have seen the difference between RRB and a bank and NBFC and a bank. RRB and regular banks and NBFC and a bank. Okay. Now Nachiket More committee. Of course, this is there in my revision slide also. This is the regular slide. Okay, document which I have given you in the regular class. Okay, so differentiated banking concept came up during the recommendations of Nachiket More committee 2013. So one of the logic is financial inclusion as well. So differentiated means you are not performing all the functions. You are only performing few functions. So with respect to differentiated banks, the question they can ask is, one is payment banks. How do payment banks function? The second is, how do small finance banks function? So first of all, based on the wording itself. So here if you see the the small finance banks are also scheduled commercial banks. Small finance, see these are factual and still I am going through them and not about concepts. My line of approach would be most important, which area there is more scope for questions coming in the exam. So questions coming in the exam, money supply, types of money, questions will come. Okay, bonds, bond yields, what are the factors that will affect bond yield, different types like sovereign gold bond, sovereign green bond or additional tier 1 bond, there can be questions. Then banking area is very important, cooperative banks, regional rural banks, okay, NBFCs, functions of NBFCs, payment banks, small finance banks. These may look purely factual, but these are the areas where questions come. Questions keep coming regularly. It is factual, so no. Factual are the areas which we have to revise. Concepts are the areas, once the concept is clear. If you know M3, there is no question of making a mistake in M3. If you know repo rate, there is no question of making a mistake in repo rate. But if there is a question in economic survey, some chapter, you have not read it, you can't mark it. Okay, so at this point, you need not read economic survey also. You should know the most important topics, few important words in the economic survey, and few graphs in the economic survey. That's all. Okay, so here see the chart. Small finance banks mainly focus. See here, these are also scheduled commercial banks, and these are part of the differentiated banking. That means they are not performing all the functions. Okay, so they are not performing all the functions. So differentiated banks here, one example of is small finance banks. In the small finance bank, it is also a scheduled commercial bank, and they give loans to small and marginal farmers, unorganized sectors, etc. Okay, so now they shall primarily undertake basic banking activities only, like acceptance of deposits or lending to undeserved sections, etc. And the minimum paid up capital 100 crores. Okay, and all prudential norms and regulations of RBI are applicable to these, which are applicable to the scheduled commercial banks, will be applicable to small finance banks. That means small finance banks also have to maintain CRR and SLR. Remember, CRR and SLR has to be maintained by small finance banks. CRR and SLR has to be maintained by payment banks. CRR and SLR has to be maintained by RRB. But CLR and SLR need not be maintained by NBFC. Need not be maintained by NBFC. That is what you should remember. Okay. Now, whatever regulations are applicable with respect to the commercial banks, okay, like the CRR and SLR, that will be applicable to small finance banks also. So, small finance banks also, these things will be applicable. And one more important aspect is 75% of the loan is to be given to priority sectors like the RRBs. Even the small finance bank, out of the total loan which they are giving, 75% of the loan should be given to priority sector lending. Another important aspect for a small finance bank is at least 50% of the loans should be up to 25 lakhs. That means you are given loans worth 100 crore, okay, 50 crore worth loans, that is 50%. The maximum amount of these 50 crore worth loans should not be more than, that is more than 25 lakhs. Small loans is the logic, no? So you have to give more small loans. So at least 50% of the loan should be up to 25 lakhs. Okay. So that is about small finance bank. So one more important aspect is the payment bank. Payment bank. See, payment bank's concept, recommendations of Nachiket more, that is one thing. Payment banks basically accept deposits, but they don't give loans. So payment banks cannot issue credit cards. Okay, they can issue debit cards, ATM cards, but they cannot issue credit cards. Since they accept deposits, payment banks also maintain CRR. Okay, and how do payment banks make money? Payment banks, whatever deposits they receive, 75% of it they will put into SLR related securities like the secured G-Secs, etc. So that is what they do. And payment banks also have to comply with all the supervisory frameworks that are applicable to all other commercial banks. This is the differentiated banking, that is small finance banks, payment banks, RRBs, and NBFC, NPAs, types of NPA, okay, IBC, haircut in IBC, and few things in the economic survey. I will come to that. So economic survey was talking about SARFAESI Act, okay, debt recovery tribunals, all that. So, but out of all this, which has helped to recover maximum NPA was the IBC, Insolvency and Bankruptcy Code. Is this okay? Students, are you there? Yes. You are able to revise, no? Or you are finding it difficult? Okay. See, in the limited time, if you have to cover more, and including something like the economic survey, etc., we can't reduce the speed. Now, if you're not following, you can tell me. I'll reduce the speed and we can discuss what we have discussed in the class. So my intention is not to just cover what we discussed in the class, because that anyhow you can revise. That anyhow you will revise, no, from the notes and all. So that we have to revise, and something additional we have to do. Otherwise, what is the point? If we discuss the same thing, what the same repo, same reverse repo, and that's the reason I did not explain what is repo, what is reverse repo. I feel what is repo, what is reverse repo is not required here. I think that procedure is okay. That method which I am following is okay for you. If it's not okay, also you can put up in the chat. I'll talk to you. Okay. Yes. See, if I'm bringing new terms for discussion, for example, I will bring few now. And it's not that you don't think like, sir, you have not taught us this new term. I can't teach that new term in the class. First of all, you should understand that. For example, there are schemes, many schemes are there. So all that cannot be discussed. In the class, it's beyond class level because it's part of the current affairs only. For example, I'll come up with one second. Suppose I ask you this question. Now, for this, now we would have discussed in the class, but this is a trend. Okay, so this is a trend-based question. Okay, so this is a trend-based question. Now, which of the following components, I'll come to, I've not started fiscal policy. Now, see this. This is the following components have a continuous, this is from the economic survey. Okay, so easily you can say, seen an increase in the last 5 years. Obviously, tax collections, you wouldn't have seen an increase, and GST, because COVID was in between. This is the logic you will use in the prelims exam. So since COVID is in between, but revenue expenditure, yes, it is spending. So there was an increase. Okay, so this is how you will use this concept. So there is this boxes in the economic survey. So economic survey box clearly shows the continuous trend. You can see the graph. These graphs are, observe these graphs. You know, one line there can be concept, second line there will not be concept. But when we say tax collections, GST collections, there is no continuous increase. In between you can see there was a dip in the financial year 2021. There is a dip again, and there's a dip, and then again there is an increase. But limited growth in revenue expenditure, but revenue expenditure you can observe there's a continuous trend that the revenue expenditure is increasing. Okay, so these are called as trend-based questions. Now, you know what are the things that will fall under revenue expenditure in the regular classes. Okay, that I'll draw the table also. But out of all the revenue expenditures, the major chunk of revenue expenditure is obviously the interest payments. Interest payments. So interest payments is the major chunk of all the revenue expenditure. Okay, so when revenue expenditure, major chunk of all the revenue expenditures is obviously the interest payments. Okay, so in the receipts, you have the expenditure receipts, you have the revenue receipts, capital receipts, and expenditure part, we have the revenue expenditure and capital expenditure, isn't it? So revenue expenditure, out of all the revenue expenditures, the major chunk of revenue expenditure is interest payments. Okay, now concepts of tax I will discuss later, but now observe, when I say tax collections, okay, this year, the direct tax collections are more than the indirect tax collections. That is something, they can ask this, indirect tax collections are more than direct. No. Of course, out of all the taxes, which tax we got maximum revenue? GST. Out of all the taxes, we have received maximum revenue from GST. But if I take direct tax and indirect tax, you can see direct tax have put 51.5, and indirect tax have put 48.5. So that means out of all the taxes, maximum money was coming from the direct taxes for the central government, and then indirect tax. But which tax maximum revenue was coming? It is obviously the GST. So that should be clear. Okay, and after GST, maximum revenue was coming from corporate tax. After GST, maximum revenue was coming from corporate tax. In the basics class, we have discussed like what is direct tax, what is indirect tax. So you know what is direct and what is indirect. Now you should know maximum tax this year was coming from direct, that is around 51.5, indirect it is 48.5. Okay, and maximum tax revenue is coming from GST followed by corporate tax. Followed by corporate tax. This should be clear. I hope it is clear. And one more thing is, when we talk about indirect taxes and direct taxes, so we all know that direct tax is the tax where the burden of the tax cannot be shifted. Indirect tax, the burden of the tax can be shifted. This is something which we all know. Okay, the impact and incidence of the tax are on the same point. That is direct tax. Impact is on the different point, incidence is on the different point. Okay, this is indirect tax. Impact means first point of contact. Incidence, ultimately, who is paying the tax? Incidence is ultimately who is paying the tax. Okay, impact and incidence are on different points. Indirect tax, same point, direct tax. Maximum collection of direct taxes, 51.5 from direct, indirect 48.5. Then maximum tax revenue has come up from GST, followed by corporate tax. Then comes the income tax. These are some facts. When we talk about income tax, government came up with new income tax slabs. Government has come up in the recent budget, new income tax slabs. So old income tax slab is not removed. If you want, you can follow that. But basically, you have come up with the new slab and old is also there. So in the new slab, few observations in the income tax. New slab. So 1, 2, 3, 4, 5 you have. 0 to 3, nil. So I have 5 slabs here. 3 to 6 lakhs, 6 to 9 lakh, observe as I am speaking. 9 to 12 lakhs, 15%. 12 to 15 lakhs, 20. Above 15, 30. So this is a little different from the earlier slab. Okay. So here, which of the following is not correct regarding tax proposals of the budget 2023-24? So this is about the new budget basically. So the number of income tax slabs in the new regime has been reduced from 6 to 5 with zero tax up to 3 lakh income. So now up to 3 lakhs it is nil. Up to 3 lakhs it is nil. 3 to 6 lakhs 5%. 6 to 9 lakhs 10. 9 to 12 15. 12 to 15 20. Above 15 it is 30. Okay, tax exemption for news agencies set up solely for collection and distribution of news will be removed. Income tax rate for new cooperative societies engaged in manufacturing has been reduced to 15. So UPSC will not go into this much depth. But at least few things you should know. First of all, you should know slab. Okay. Second, you should know tax rebate. Now, tax rebate earlier it was up to 5 lakhs. Now tax rebate, government said we are giving tax rebate up to 7 lakhs. 7 lakhs. Third, you should also know about surcharge. You should know about surcharge. So highest surcharge that is going to be levied, earlier it is something like 37%. In the recent budget, the highest surcharge has been reduced from 37 to 25%. Highest surcharge has been reduced. So highest surcharge that is there now is only 25%. Earlier it was 37. So surcharge is not on everybody. Once my income crosses 50 lakhs, surcharge will start. Okay, so once it crosses 50. 50 to 1 crore, one aspect of surcharge. 1 to 2 crore, one aspect. But highest surcharge above 5 crores, earlier it was 37%. Now it is 25%. Okay, so this is something which you will remember. And tax rebate is also up to 7 lakhs. Okay, so this is the previous slab. This is the old tax regime. Old. This is the old. This is the old regime basically. And I've shown you the new regime also. This is the new regime. That is up to 3 lakhs you're not paying. And rebate is up to 7 lakhs. Above 15 lakhs, 30% bracket. Okay. Now see, in the economic survey, there is this word called pent-up demand. Okay, so economic survey, there is this word called pent-up demand. So what is pent-up demand? It is nothing but a rapid increase in demand for a product after a fall. After a fall, if it is increasing. After a fall, it is increasing. That is what is called as pent-up demand. After a fall, it is increasing. That is what is called as the pent-up demand. Okay, so pent-up demand, this is rapid increase in demand of a product after a period of subdued spending. Okay, this of course in the inflation class, inflation related diagram for the economic survey. But what is pent-up demand? There can be a question in the exam. So that becomes important. Okay. Now, economic survey basically, economic survey talks about a word called non-financial sector debt. Non-financial sector debt. Now, these are some additions. So, economic survey has given a chart and it talks about this debt called as non-financial sector debt. So, what is this non-financial sector debt? It consists of credit instruments issued by government entities. Credit instruments like bonds, etc., by government entities, households, businesses that are generally not part of the financial sector, like the banks, etc. Like the banks, etc. Okay. Now, other countries, this non-financial debt increased. Okay. But in India, if you take the statistics of last 12, 13 years, our non-financial debt decreased. Non-financial debt did not increase. That is through bonds, etc. So that is what you will remember. Other countries it increased. Okay, so but in India non-financial debt did not increase. That means through bonds, other instruments, etc. issued by government entities, households or businesses that are not the regular financial sector. That are not the regular financial sector. Okay, so regular financial sector is the banks and all. Okay. And economic survey also uses a word called effective capital expenditure. Okay, so effective capital expenditure. Everybody knows what is revenue expenditure, capital expenditure. Of course, the basic table also I will draw. But effective capital. Economic survey says effective capital expenditure is 10.68 lakhs in 2022-23. So if they ask this term, what is effective capital expenditure? They can ask in the exam, what is effective capital expenditure? So effective capital expenditure of the central government means it includes the capital expenditure. Okay, so mainly for creation of assets, etc. Along with that, the grants in aid. So along with that, the center would have given some grants to the states. And states have used it for capital purpose, capital, building assets, etc. So, whatever capital expenditure for building assets center has used, plus grants given by the center to states for building assets, both put together, the economic survey was calling it as effective capital expenditure. So, the budget also saying effective capital expenditure of the central government is 10.68 lakh crores in 2022. 2022-23. You don't worry about the question. Question is not for you. For you, only the word. What is effective capital expenditure? That's all. So don't worry about the question and the answer. I am only interested in the word, please. Okay, so I'm only interested in the word. Don't worry about the question. So again, that will confuse you. Remember what is effective capital expenditure. That's all. Okay, effective capital expenditure along with the money spent on assets. Along with that, the grants in aid to the states. Is this clear? Okay, okay. So now we will do fiscal policy. Of course, you have seen taxing and all. I'll do fiscal. We will do the record. We will do the revision of fiscal policy, inflation, and WTO. These three huge topics. Of course, in fiscal policy, then I will show you some details of economic survey also. Okay. So in fiscal policy, basically, what are the questions that can be asked or the terms? So fiscal policy means one is something related to budget, and second is related to taxing. One is the budget and the second one is the taxing. Okay. So what kind of questions? One is the trend-based questions. Trend-based questions is what direct taxes increased, decreased. Okay, indirect tax increase, decrease. That is basically called as the trend-based questions. Okay, second is some conceptual questions. Trend we have seen few already, and then let's see the conceptual questions now. Okay, so some words. So cascading effect is something like tax on tax, which we know already, and then transfer pricing. Transfer pricing. So there are some terms they can ask in prelims. Okay, so transfer pricing is something like pricing between two known entities. Pricing between two known entities. Okay, so basically transfer pricing is done for tax avoidance. Transfer pricing is done for tax avoidance. So you have Vodafone India and Vodafone Mauritius. Both are sister concerns. So transfer pricing is a pricing mechanism between two known entities. So wantedly they will avoid taxes. So transfer pricing is used for even base erosion and profit shifting. Base erosion and profit shifting. So what is this base erosion and profit shifting? You're trying to shift the profits, the company is trying to shift the profits from one country where the tax rates are low, tax rates are high, to country where the tax rates are low. So that is what is called as base erosion and profit shifting. So you're trying to shift the profits from one country to another country. So from a country where the tax rates are high, you're shifting the profits to a country where tax rates are low. Okay, so this is called as base erosion and profit shifting. Okay. Then, what is this tax elasticity? Tax elasticity and tax buoyancy. So this is something which you should be knowing, and these words can come in the prelims. Okay. So when I say tax buoyancy, it is percentage change of tax induced by change in GDP. Induced by change in GDP. Percentage change of tax induced by change in GDP. Okay, so that is what is tax buoyancy. Tax buoyancy. Okay. Now, tax elasticity is percentage change in adjusted tax revenue to the change in GDP. Adjusted tax revenue to the change in GDP. So here when I'm using the word adjusted, so what is this adjusted? Simple way. Okay. So adjusted means you're not taking the discretionary change. Okay, so here this change in tax can be because of automatic plus discretionary, both discretionary. When I say tax buoyancy, the change in tax can be because it is automatic as well as discretionary change. But when I say adjusted tax revenue, so adjusted tax revenue, okay, adjusted tax revenue means you're not taking the discretionary change. That means from the total tax revenue, I am removing the discretionary change. That is what is adjusted tax revenue. So tax buoyancy and tax elasticity. Then progressive taxing, regressive taxing, proportional tax. So our indirect taxes are seen to be regressive in nature, because the poor man ends up paying higher proportion of his income as tax. And that is the reason we say indirect taxes are seen as regressive in nature. Okay, so when I use the word proportional tax, so proportional tax, example of a proportional tax is corporate tax. Corporate tax. So corporate tax, irrespective of profit or income, irrespective of profit or income, if the tax rate is constant, tax rate is constant irrespective of profit or income, we use the word called what? Proportional tax. Proportional tax. And new tax slabs have shown you 0 to 3 lakhs, 3 to 6 lakhs. Remember, tax 0 to 3 lakhs in the income tax, 0 to 3 lakhs, there is no tax. This is called as tax exemption. Tax exemption. Exemption is for everybody. Okay, but up to 7 lakhs, government said there is a rebate. Rebate is not for everybody. When I say tax rebate, rebate is not for everybody. So that means if your income is 7.1 lakhs, you are not eligible for rebate. Up to 3 lakhs, you have to pay 0, that is exempted. Rest of the 4.1 lakhs, suppose your income is 7.1 lakh, means up to 3 lakhs, okay, you will pay 0, but rest of the 4.1 lakh, I have to pay it at a rate of 5%. So rebate is not for everybody. Rebate means your income should be up to 7 only. If it crosses 7, you are not eligible for rebate. You're crossing 7, you're not eligible for rebate. So this is some words you should be knowing, important. Okay. And then in the methodology of taxing, you should also know the difference between ad valorem methodology of taxing and also the specific tax. Specific tax. So when I use the word ad valorem, so if the tax is levied as a percentage of value of goods, as a percentage of value of goods, regardless of number of units produced, okay, it is ad valorem. If it is levied as the tax is levied as a percentage of value of goods, regardless of number of goods produced. On value, if you are levying on the percentage of, for example, excise duties, earlier excise duties and all, so it is levied, it's an ad valorem tax. Ad valorem. But what is specific tax? Tax levied at a flat rate per unit of goods. Tax levied at a flat rate per unit of goods produced, sold, whatever it is. Okay, so regardless of the value, this is regardless of value. Specific tax is regardless of value. There will be some basic questions if he wants to ask. Very simple questions. You can eliminate and mark the answer, but you should know what it is. Okay, regardless of value. For example, if it is based on, suppose tax is levied on quantity produced, or tax is levied on the length of the car, length of the cigarette. Lengthier the cigarette, there is more tax. So length of the car, length of the cigarette. So these are all specific taxes. So that much should be clear. Okay. And when we use the word ad valorem, it is on the value of goods. That much should be clear. That's all. Okay. And then in the taxing again, government came up with the concept of mod VAT, modified value added tax. This is basically with respect to removing the cascading effect with respect to excise. So mod VAT was introduced basically in 1976 based on L.K. Jha committee recommendations. L.K. Jha committee recommendations. Okay, mod VAT was introduced. So mainly to remove cascading effect with respect to excise. Cascading effect with respect to excise. So then this, earlier it was, now this mod VAT, man VAT, it was called as man VAT. Man VAT is manufacturing VAT. Manufacturing VAT. Manufacturing VAT. And then it was turned out, you changed it to mod VAT. So mod VAT specifically, it was 1986. Modified VAT. Okay, so man VAT is manufacturing VAT. Then mod VAT. And this mod VAT again was changed into Sen VAT. Sen VAT is Central Value Added Tax. Now the same Sen VAT is again pushed into CGST. CGST. Okay, today you don't have CENVAC, no, central value added tax is not there. Today it is central goods and services tax and state goods and services tax. Okay, so that should be clear, no confusion here. Okay, so similarly, when I use the word customs, customs is on import and export. In the class we have discussed on import and exports, custom duty is going to be levied. And most importantly, the basic customs duty which we know, the basic customs duty is outside GST. Basic customs duty is outside GST. So when we talk about GST, there are certain goods even today on which there is no GST. For example, alcohol for human consumption. Okay, then we have the petrol and diesel. Okay, so there is no GST. Electricity is still outside GST. That means we pay electricity related taxes to the state. So similarly, basic customs duty, basic only. Okay, so above the basic customs duty, we have the additional customs duty or the countervailing duties. They are included in GST. So after the basic customs duty, we have the additional customs duty or the countervailing duties. So countervailing duties are mainly levied to handle excess subsidies given by other countries, etc. So countervailing duties plus the special additional duties, they are subsumed into GST or they are subsumed into the IGST system. They are subsumed. What is outside the GST is only the basic custom duty. But when I use the word countervailing duties or the special additional duties, they are included in GST. So you should not get confused. That is very important. No confusion there. Okay. And our GST basically is called as the destination based tax. Destination based tax. Okay. So today even octroi is also included. Okay. So when I use the word GST, it's a huge reform basically. And you have to remember few facts in GST. First fact is something like France was the first country to introduce GST. France was the first country to introduce GST. Okay. And India's GST model is very close to the Canadian model. India's GST model is very close to the Canadian model. Okay, so GST came into picture in India 1st July 2017 onwards based on 101st Constitutional Amendment Act. So it is one of the largest indirect tax reform. So almost if you observe what are the taxes replaced in GST. So central excise duty and service tax both were subsumed into CGST. Okay. So duties on excise related to medicinal and toilet preparational. Okay, but excise on alcohol still state is handling. Alcohol used for medicine and toilet prep, it is subsumed into GST. Okay. Then we have special additional duties on customs. Are subsumed into GST. They are part. Okay. Central sales tax is not there anymore. CST is not there. Whenever CST is something like an origin-based tax. CST was an origin-based tax where the CST revenues were going mainly to the exporter state. Whenever there is interstate trade, CST revenues were going to the exporter state. So CST has been removed and you have an IGST system today, integrated goods and services tax system. Okay, so that is something which we should know. And even this in the state government taxes, that is whatever taxes the state has started levying, these are the taxes that are subsumed. For example, the state VAT is already subsumed, entry tax is subsumed, entry taxes are subsumed, so octroys, etc., they are also subsumed. Okay, entertainment tax is subsumed, entertainment, SGST only, entertainment tax is subsumed. Of course, there are some exceptions. Suppose this entertainment tax is subsumed except when levied by local bodies. except when levied by local bodies. Okay. Then taxes on advertisements and gambling, etc. Taxes on lotteries and gambling, advertisement and all state list, isn't it? Okay, so they have to be subsumed in SGST only. Okay. We don't pay newspaper GST when we are buying newspaper, but advertisements in newspaper there is GST. Okay, advertisement in newspaper there is GST. These hoardings and all advertisements are there. This we used to pay to the state earlier. Okay, the municipal corporations, etc. So these are all state related. So they have to be subsumed into SGST. Okay, so that is something which we have to remember. Okay, and then lottery and betting. Lotteries, tax on lottery and betting. Lottery and betting, all this. But even now the GST is excluded on 5 petroleum products. GST is excluded on 5 petroleum products. Okay, so crude, motor spirit, like this, diesel, high speed diesel we call it as, natural gas, okay, aviation, turbine fuel, etc. So these 5 petroleum products are still outside GST. 5 petroleum products are still outside GST. Even today they are outside GST. Okay, so these 5 petroleum products are outside GST. Tax, then electricity is also outside GST. Electricity is also outside GST. Alcohol for human consumption, which we call it as the portable alcohol, is outside GST. Tobacco was outside GST earlier, now tobacco is within GST. So tobacco and tobacco products were included into GST. So that is something we should know. And remember, there was this GST compensation cess. I'll talk about it. There can be a question with respect to compensation cess. So we followed a dual GST system. You should remember that. So dual GST system means you have CGST and SGST being levied together. So whenever they are levying, you have the 0% bracket 5, 12, 18 and 28. 0, 5, 12, 18, 28. Put it on mute. Yes. Okay. So 0, 5, 12, 18, 28 are the brackets. And these are something which you already know. And that is the reason, like, I think you know, most of you know. And what are the main articles which are required to be remembered with respect to GST? One is the 246A, which talks about the dual GST system. That is, both center and state we have the authority to levy GST. Okay, so then we have 269A, which talks about the IGST system. But what the article says, remember, IGST is going to be levied by center. IGST is going to be levied by center. Okay, because interstate trade. Interstate trade, Article 269. Article 269 talks about interstate trade, and interstate trade, it is levied by any sale, interstate sale also. The levying powers is with the center. Okay, so therefore IGST also will be levied by center. Okay, and any changes on the sharing mechanism between states under IGST will be decided by the GST Council. GST Council. This is what the article says. And the article also says one more thing. The article says that whatever proceeds which you get from IGST, these proceeds will not be pushed into Consolidated Fund of India nor Consolidated Fund of State. They are not put into Consolidated Fund of India nor Consolidated Fund of State. So this is what the Article 269A says. And then you also know about Article 279A. 279A, basically it talks about GST Council. GST Council. Okay. Then we should also be knowing National Anti-Profiteering Authority. Mainly this mechanism has been brought in under the GST law. GST law, anti-profiteering GST law to check unfair profit making activities by trading community. Simple logic. Whenever GST council reduces the tax, maybe shifts the slab from 12 to 5, whatever it is, okay, the trader also has to do it to the consumer. If the trader doesn't do it, then the trader has to find out where the consumer is and give away his money, including interest. Now, if you're not doing that, that is basically profiteering. So you have to prevent profiteering, and this authority has been set up under the CGST law, CGST Act, okay, which is called as the National Anti-Profiteering Authority. National Anti-Profiteering. That means what? We are trying to prevent profiteering. Prevent profiteering. So that is what is called as National Anti-Profiteering Authority. Okay. So then there is this word called GST compensation cess. There can be a prelims question here. GST compensation cess. Okay, so GST compensation cess. Why? Because there are some manufacturing states which were losing revenues because of GST. Earlier, before GST, they used to get CST revenues, exporter state. No, so now they were losing revenues because compensation. Because of the new IGST system. Because IGST proceeds were going to the importer state. So exporter states were not happy. So they've come up with the GST compensation cess. And so this compensation cess is to mainly compensate the bigger states like Gujarat, Haryana, Karnataka, Maharashtra, Tamil Nadu, which were worried that they will lose out revenue, etc. So initially government said first 5 years we will take care of you. That is from July 1st, 2017 to July 1st, 2022, July 2022. They said we will take care of you by giving you some money in the form of compensation. So we will collect this compensation cess and we will give you money. Okay. So this is calculated based on the, there is a separate act for it, which is not required. GST Compensation to States Act 2017, not important for UPSC. So, but these compensation cess separately is levied on certain goods which are called as the sin goods. Sin goods, they are levied. Okay, like pan masala, tobacco, all are sin goods. And also it is levied on automobile. Automobiles also, don't forget. Automobile is not a sin good, but automobiles also, GST compensation cess is levied. That is what they have decided. So this is basically called as the GST compensation cess. Okay, and this is very simple. And they may ask a prelims question in this area because till now they have not asked. Then GST network, GSTN, is called as the GST network. So GSTN is nothing but GST network. Okay, so when I use the word GST network, this is basically a non-profit organization, but now it is completely under the government. Now it is completely under the government. It handles the complete IT system of the GST portal. Entire IT system of the GST portal is handled by the GST network. Okay, so mainly government uses this portal to track every financial transaction. Every financial transaction, to track that every financial transaction, how much tax has to be paid, what are the services, who are the registrants, how money has to be transferred, everything will be handled through this GST network. So it is a non-profit government entity. Earlier it was non-profit, non-government. Now it is non-profit government entity. Okay, so that much should be clear. Okay. Then I hope it is clear. I hope everybody you are able to follow. Okay, so is it clear, everybody? Are you there? You are there. Students, I will give you break again at 7:75 and again I will take till 9. So when I am giving break at 7 o'clock, eat something. Most of you are at home or in your rooms only, no? So, yes. Okay, so now that is about the GST network. Similarly, there are some bills with respect to GST which are called as the e-way bills. So suppose he's asking what is e-way. So it is nothing but electronic way bill system. So it's a technological framework to track intrastate as well as interstate. Both. It is valid for intrastate as well as interstate. When you are moving goods And the value of the goods, if it is exceeding 50,000, and if 50,000 for sales and it is beyond 10 kilometers range, okay, then there is this e-way bill provision. Okay, so it's an e-way unique bill basically, and it helps, and this bill is given to the supplier, recipient as well as the transporter. So seamless logistics service. Seamless logistics service can be ensured through e-way bill. Okay, so if you are without generating a valid e-way bill, if the goods are transported, a fine of rupees 10,000 can be levied. Okay, so that is, and also the goods can be seized. So it helps in manufacturing efficiency. It helps in manufacturing efficiency. Okay, so somebody, Manjunath, he's in the waiting hall only. I don't know what, I think there is some technical problem. Okay, so so fine of rupees 10,000 can be levied if a consignment movement without generating valid e-way bill. Okay, so yes. So I think till here it is clear. This is about GST. Basic only. Don't dig deep into GST. See what questions were asked, what can be asked. Okay, and then prepare. Intelligent way of preparation. Okay, so anything related to GST, of course, previous questions, many are there, but easy questions only. Okay. Okay. So this is about the direct taxes, which are indirect taxes. Now we will see some revision of the direct tax. Okay. So direct taxes, as we have already discussed, revenue collected from direct taxes is more than the revenue collected from indirect taxes in the recent statistics, obviously. So there are some direct taxes, mainly central as well as state. So different types of direct taxes, which were there earlier, which are not there also, we will see. Okay, so for example, we have income tax. Income tax slabs are important. Maximum surcharge above 5 crores reduced to 25%. Okay, tax rebate up to how much? How many slabs currently? 5. Earlier system is there and still the new slab has been launched. Earlier system is not completely dismantled. This is about the income tax, which you have to remember. Okay, so direct tax, we have income tax, we have corporate tax. So second largest tax revenue is mainly coming from corporate tax. Earlier it was first, now it is after GST. Okay, and then we have the minimum alternate tax, MAT we call it as. Minimum alternate tax. So minimum tax which is levied on book profits, Okay, so this is on companies, If you are levying on individuals and limited liability partnership companies, you call it as alternate minimum tax, AMT, alternate minimum tax. This is what is MAT, and you have AMT, alternate minimum tax. Now today you do not have wealth tax. It's also a direct tax which was dismantled, removed on the wealth. So it is removed in 2015 by Modi ji, because he felt that it is not giving much revenue. It is waste. If revenue is not coming and you are holding a tax, means it's a waster. So therefore wealth tax has been removed. You do not have estate duty. Okay. Earlier there was banking transaction tax. Every bank transaction, 2006 basically, banking transaction tax, which was also a direct tax. But today you don't have a banking transaction tax. Dividend distribution tax was also removed in the recent past. DDT we call it as. On the dividends distributed, this tax was levied on the employer who is distributing the dividends, employer or the company basically, company which is distributing dividends to the shareholders. Dividend distribution tax was levied. Okay, so then we have CGT, capital gains tax, capital. So paid by the seller capital gains tax, again we have long-term capital gains tax and short-term capital gains tax. Long-term and short-term. Okay, so then we have security transaction tax on the securities. Commodities which are traded in the commodity exchanges, we have CTT. CTT is commodity transaction tax. There are some direct taxes levied by the state also. State also levies some direct taxes. So state levies, suppose property related taxes, professional tax, which we pay. So all these are direct taxes levied by the state basically. Okay. Then with respect to direct taxes, so one more thing is, earlier this was there, but now it is not there, which is called as the fringe benefit tax. So tomorrow if he's asking which of the following is not a direct tax, you should be able to identify, that's all. So very simple only, just identify. FBT, fringe benefit tax, fringe benefit tax. Okay, so fringe benefit on the fringe benefits paid by, given by the employer to the employee. Other than the salary, they give petrol allowance, that allowance, this allowance. So these are all fringe benefits. So tax that is levied on the fringe benefits given by the employer to the employee. So all these are called as fringe benefits. Okay, so it was started in 2005, removed in 2009. So today we don't have fringe benefit tax, but you will remember that fringe benefit tax is also a direct tax paid by the employer who is giving the fringe benefits. Okay, so then when we talk about capital gains, suppose I say long-term capital gains tax. So if you're holding the asset generally, most of the time, if you're holding the assets for more than 36 months, that is 3 years, then you will be paying long-term capital gains tax. Okay, so general. So any asset that is held for more than 36 months, you pay long-term capital gains tax. Okay. And basically when you are paying long term, then obviously short-term capital gains tax will not be applicable. Okay, so and basically here what we should understand is every instrument has a different way. So if you are not holding it for 36 months with respect to the land, building, etc. But when it comes to shares, etc., long-term capital gains tax for shares is 1 year. That means if you are holding shares for a period of more than 1 year, then you are eligible to pay long-term capital gains tax. Eligible to pay long-term capital gains tax for shares. But other land and all, it is generally 1 year. If you are holding it for a period of more than 1 year, we pay something called as long-term capital gains tax. If you are holding it for less than 3 years, basically, that is less than 36 months, we pay something like the short-term capital gains tax. So short-term capital gains tax, generally, there is no number that is given. Generally, it is the income which you get will be added to your income tax slab, and then whichever slab you fall, you pay accordingly. Okay, so they will not get into it, but at least you should know long-term capital gains tax, not more than 36 months generally, and for shares and all, it is 1 year. More than 1 year if you are holding, you can pay long-term capital gains tax. Okay, and whenever there are too much of exemptions with respect to capital gains tax, and that is the reason government started stressing more on securities transaction tax. Any tax payment any stock market transaction we are doing, so government is mainly focused on securities transaction tax. Okay, so this is something which you should remember. DDT not there now, but it is on the dividends. Okay, so that should be clear. Okay, so if at all there is a question asked on what are the examples of direct taxes, indirect taxes, etc. Okay, now budget. So here, when we talk about the budget, okay, we know that there is a revenue account. In the revenue account, we have revenue receipts, we have the revenue expenditure. In the capital account, we have the capital receipts, and we have the capital expenditure. This is something which we already know. Okay, but for your convenience, basically, So when I talk about revenue receipts, we say both, that is tax source as well as non-tax. Non-tax. So tax source revenue receipts are again divided into direct taxes and indirect tax. Direct tax as well as indirect tax. Okay, so non-tax revenue receipts. So non-tax revenue receipts, we have, okay, if I have to write tax and non-tax. Okay, so we are talking about revenue receipts. So when I say non-tax revenue receipts, so non-tax revenue receipts, we have many non-tax revenue receipts. So fines and fees, okay, so fines and fees paid, profits of PSU, profits of PSU. These are all non-tax revenue received. Interest received, major, okay, received, sorry, interest received. Received, this is not expenditure. Okay, so highest amount of revenue expenditure is interest payment, remember. So here it is interest received I have written. Okay, so then we have many things like that. Grants received, grants and gifts. Grants and gifts received. All these are revenue receipts. Okay, and then receipts from economic services. Receipts from economic services, receipts from social services, general services, social services, receipts from general services like police, UPSC, all that. Okay, and then dividends received, interest received, etc. Okay, so all these are non-tax revenue receipts. And in the revenue receipts tax source, we have direct taxes, we have indirect taxes. Okay, and then revenue expenditure. Okay, revenue expenditure, maximum chunk is interest payments. Okay, salaries and pensions. All these are revenue expenditures. Grants given. Okay, interest paid, dividends paid, interest paid, all this. Defense expenditure. Okay, and then we also have the payments made on general services, economic services, social services, all this. Then postal deficit, all this is part of revenue expenditure. Okay, now this is about the revenue part. Then in the capital part, we have the capital receipts. What are capital receipts? Capital receipts are those receipts that will reduce the assets or increase the liability. Capital receipts are those receipts that will reduce the asset or increase the liability. All this is a recap only. So capital receipts are those receipts which will reduce the assets or increase the liability. So when I talk about capital receipts which reduce the assets or increase the liability, this is what is capital receipts. Okay, so loans given, receipt means incoming, loans taken or borrowings basically. So loans taken, okay, so loans taken by government. Okay, then loans recovered. Okay, disinvestments. Disinvestment means asset is decreasing. Loan is recovered, asset is decreasing. Loans taken, liabilities are increasing. Okay. Then capital expenditure. Capital expenditure means asset will increase or liabilities will decrease. Asset will increase or liabilities will decrease. So loans given to loans repaid. 3, infrastructure creation. I have used the word effective capital expenditure used in the economic survey. So there's something that is used for creating assets plus grants given by the central government to the states, which the states have used for building assets. All this put together is effective capital expenditure as stated by the economic survey. So they can ask such terms in the exam, and therefore if you know the answer, automatically by looking at the option you can mark it. So infrastructure creation, etc. Okay, buying defense equipment, not defense. The equipment, machines you are buying, suppose. Okay, you're buying some missiles, etc. All that is also capital expenditure. So that is about. Then when we talk about the different types of deficits, so revenue deficit is seen as the most dangerous form of deficit. We all know this deficit. The revenue deficit is seen as the most dangerous form of deficit. So revenue deficit is nothing but revenue expenditure minus revenue receipts. Okay, and then we have effective revenue deficit. Effective revenue deficit is nothing but revenue deficit minus grants given by the central government to states for capital purpose. Okay, and then we have budgetary deficit, that is total expenditure minus total receipts. Okay, and then we have FD, fiscal deficit. Fiscal deficit is nothing but BD plus borrowing, or is BD is made zero. So FD, fiscal deficit, is nothing but borrowings of the government. Then we have the primary deficit. So primary deficit is nothing but FD minus interest payments. Okay, so this is something about the deficits which we should know. Okay, I hope it is clear till here. Hope you are able to revise. Okay, now so of course this everything you can't remember. So see, the budget basically 7 focuses, Saptarishi, 7 priorities, Amrit Kal. Okay, so inclusive development, reaching the last mile, youth power, financial sector, green growth, unleashing the potential, infrastructure investment. Okay, this is called as the Saptarishi. Okay, so Saptarishi in the budget basically. So here capital expenditure has increased 4 times from 2016. See the first chart. Capital expenditure has increased 4 times. Okay, so from 2.5 lakh crore to almost like 10 lakh crore. Capital expenditure of union government. Okay, asset quality in banks improving over the years. Okay, so asset quality is improving over the years. Statement true, with lower NPAs according to the budget. True. Okay, so observe that the second graph there. I'll come to inflation, CPI combined CPI. So here the budget says, see the fourth graph, I'm moving away. There is a merge between the CPI and WPI index. So they are coming together. Earlier it was wide. By December 2022, you find that the WPI has come very close to the CPI. Okay. So India has sufficient forex reserve. So largest forex reserve holder is China. And India till the recent past was fourth rank with respect to forex reserve. Fifth rank, now fourth. Okay, so basically forex reserve, largest forex reserve is China first and then followed by Japan. Okay, so India ranks fourth. This is clear. So this is something like earlier we did not have forex only. Okay. So when I say import coverage, UPSC asked this question earlier, import coverage ratio. That means how much forex reserve you have to cover your imports. How much forex reserve you have to cover your imports. That is what is called as import coverage ratio. Already asked in UPSC earlier. So this we have seen already, new income tax regime. I've already mentioned this, surcharges, etc. Okay, so surcharges, etc. and income tax. Okay, so rebate also, rebate 5 lakhs to 7 lakhs. And this is all stated in the budget in the new tax, income tax regime. Okay, so that is something which we should remember. Maximum surcharge 5 crore and above to be reduced from 37 to 25. We have seen that already. Okay, so here rupee comes from, maximum rupee is coming from, observe there. Okay, so after borrowings and other liabilities, okay, so maximum money is moving in use from GST, goods and services tax. Then it is corporate tax, then it is income tax. Okay, so that is something which you have to. Non-debt capital receipts is less. Don't? Tomorrow question comes in non-debt capital receipts. What are non-debt capital receipts? Non-debt capital receipts. Anybody? Just, I'm asking you, can you put the examples of non-debt capital receipts in the chat? Non-debt capital receipts in the chat? Yes. Yes, yes. Students. Non-debt capital receipts. Yes, one is disinvestment. Then what else? Non-debt capital receipts. Loans recover. No grants. No grants. Grant is not capital receipt. Grant is revenue. Don't make such silly mistakes. No grants. Loans recovered. Yes, loans recovered and disinvestment. Loans recovered and disinvestment. Why external borrowing? There's nothing like external, internal. You are getting confused with BOP and government's budget. Okay, so why are you putting FDI? This capital receipts, you are getting confused with the BOP account. BOP, external sector. BOP account, that is also an accounting statement only. I'm just sitting in front of the system only, observing your answers. Now, BOP, balance of payment, accounting statement of residents of India with rest of the world. Okay, that discussion is not today. Tomorrow we will discuss. Don't get confused. ECB and all will come there. Of course, borrowings and all here also same, but your external borrowing specifically you are talking means you are getting confused. Okay, so non-debt capital receipts of central government's budgetary account of budget. Okay, so you have disinvestments, yes, and loans recovered. Loans recovered. Okay, not loans taken. Loans taken is debt creating. Not loans taken. Somebody has put borrowing. Borrowing will not be non-debt. No. When he's saying borrowing means it can't be non-debt. It is debt. Non-debt means it can't be borrowing. Huh? So, yes. No confusion. Don't make silly mistakes. This is rupee goes to. Rupee goes to, observe properly. Maximum is going where? Interest payments. Okay. Not even shares, state's share of taxes and duties. Tomorrow statement comes up out of all the total revenue expenditure, state share of taxes and duties is max. No, that is 18% only. That is 18% only. Observe. Okay, that is 18%. And here interest payment is 20. Okay, central sector schemes. Central sector scheme is different from centrally sponsored scheme. Central sector means completely given by center only. Centrally sponsored means center will put some, state will put some. Okay, here central sector scheme is also 17%, defense C 8%, subsidy C 7, order also something like interest payments maximum, then state share of taxes and duties, what center is sharing with the states, 18%. Okay, so observe that. Defense is 8, centrally sponsored scheme 9%, central sector scheme 17, central sector scheme completely by the central government, centrally sponsored scheme, central will put some, state will put some. Observe the numbers. Tomorrow, suppose an order comes up, no order you have to. So it should be interest payments 1. That is something which you'll remember. And out of defense and subsidies, defense is above subsidy. Logic also can be used. No petrol, diesel, no subsidies nowadays. Okay, so that logic can work. Okay, then you have this separate allocation for specific ministries. How much? Okay, so I will come to the which scheme has been given maximum. Okay, I'll come to that. Okay, allocation to major schemes. So they have used this term effective capital expenditure. This term. Okay, in the budget. That's the reason I have asked you that question. Effective. What is this effective capital expenditure? They put capital expenditure on center spending on assets plus whatever grants they gave to states which they have used for building capital. So 23 revised estimate 10.5 lakh crore. Next year estimate is 13.7, but revised you can see 23. Okay, so that is about effective capital expenditure. Okay, now before few more things which can come in the exam. Now see this. Now see here. Total capital expenditure. This is a graph. This is a graph from Economic Survey and Budget. Okay, so lakh crores. Total capital expenditure grew at an average rate of 13% during financial year and financial 2022. There's a growth. Okay, there's an increase. Now, out of the total capital expenditure on infrastructure, which one there is a maximum increase, maximum growth, you can see road, transport and highways. Center's capital expenditure, you can see tomorrow there can be a factual question. So center's capital expenditure focused on infrastructure related aspect. Maximum growth you observe there, maximum growth 102.1% growth you can see. Okay, mainly with respect to road, transport and highways. Road, transport and highways. Okay, so that is the observation there. Okay, so road, transport and highways maximum, not defense, not defense. Growth is maximum, not defense, it is road transport. So you can 0.74 lakh crores. Okay, so road, transport and highways, then railways, then defense, capital outlay, capital outlay. Okay, so that you will remember. Tomorrow, don't get confused with respect to the capital expenditure focused on infra related. That means centers capital expenditure maximum growth is in road, transport and highways, followed by rail, followed by defense. Followed by defense. This is about the capital. This is the Economic Survey 2022-23 data. Economic Survey 2022-23 data. Okay, tomorrow you know about capital expenditure, but suddenly you will find road, transport and highways is the second largest, or government spend more on railways or defense. That is wrong. That can't be right. Okay, so this is factual. For this, no concept will save you. No concept will save you. For example, the third statement, see, only observe the third statement. Presently, the capital outlay to defense services amounts to the highest share of capital expenditure of the central government. No, it is not defense. It is road, transport and highways. So like that, there will be statements in the exam. And then you don't know. You know what is capital expenditure only. Okay, so financial year, capital expenditure of the central government accounted for more than 10% of India's GDP. More than 10% means it's too much. 4% of GDP itself is too much. 10% is too much. Okay, so capital expenditure in India has doubled in the last 5 years. That is true. That is something which you will remember. Capital expenditure in India has doubled in the last 5 years. Okay, so that much, that is okay. Last 5 years, capital expenditure has doubled. Okay, so from 2018, if it is around 6 lakh crore, it is something like 12 lakh crore. So more than doubled. Yes, that's okay. Okay, so that statement is okay. So like that, these are factual. You should use logic and you should play with the options. Somebody is reading since last 4 or 5 years also. That fellow also cannot mark it unless and until he knows how to use the logic and options. You play with the options. Okay, so otherwise it is difficult. Okay, so there can be question in this area. Okay, so capital expenditure doubled from 1.8 lakh crore to 4.5 lakh crore 2023. So doubled, more than doubled. Yes, more highest which one? Rail. It is not defense. That is a factual statement which you will remember. Okay, there is a graph in the economic survey last 5 years. Okay, capital expenditure last 5 years. 1.8 lakh crore, 4.5. More than double. Yes, more than double. Okay, so these are facts. These are facts. Here we will make mistakes. So these are more important in the rapid revision class. Okay, so that should be clear. Okay, so here if you see, there is a question. I want you all to see the question. Though it is light, because from the iPad it is getting reflected on the digital board, no? And it is copy pasted. Okay, so we are, it is becoming difficult. Of course, this question I have taken from Vision test series. Okay, it's a mix of many. So now see this question, but this helps me to understand the capital expenditure. So question is not important, but just observe about the capital expenditure only. So reference to capital expenditure, consider the following statements. So see the first statement. Infrastructure class I have explained. You should use that knowledge. Crowding out private infrastructure, capital expenditure into infrastructure will always crowd in. It will always crowd in private investment, not crowd out. So that is the clue. So it's not crowd out, rather it is crowd in. So more capital investment will come. So it's not crowd out, rather it is crowding in. So that's the reason. Okay, so like this. Demand will increase, no, jobs will, multiplier effect, etc. So this chart I have shown in the class. This chart, of course, in the infrastructure class, of course, you should remember how infrastructure will lead to crowding in effect. Okay, multiplier effect on GDP, crowding in effect, etc. Okay, so see this chart, this is from economic survey and budget. Okay. So this is a graph which shows increasing union government capital expenditure to GDP ratio. Capital expenditure to GDP. 22.9. How can it be 10%, etc.? Okay, so 2.9. Observe earlier it is 1.6. Now it is 2.9% of GDP. Less than 5% only, obviously. Okay, so that is something like your observation. Use logic. Brain has to work. Logic has to work. Without knowing the answer, we can mark the answer. Okay, see this graph. This is again from budget. Observe the trend. Observe the trend here. Okay, only observe the blue one, that is about the targets of fiscal deficit. Fiscal deficit, the blue line which is going up. So that is the target of fiscal deficits. No, fiscal deficit did not increase continuously. It increased to 9.2% of GDP. 9.2% of GDP, and then it reduced. And then it reduced. Okay, so in the budget there are targets. I'll show you the budget document. Okay, see this. This is the budget targets. Okay, so trends you can observe. Fiscal deficit, you see. Financial year 2021, 9.2 FD. Now budgetary estimate 2024, 5.9. Okay, 5.9. Observe that. Then revenue deficit, see. Financial year 2021, it reached to 7.3. Now the target in this budget, budgetary estimate 2.9. Primary deficit, see, 5.8, 2021. Now target is 2.3. 2.3. This is the budget document straight. This is a straight budget document. Okay, so continuous increase, continuous decrease, these kind of questions. You need not be confused here. Okay, so this is how it is. 9.2, COVID impact, no, 9.2% of GDP, FD, such a high level. We need to be a little fast, but of course this area is also important. That's the reason I'm spending some time. Okay, so please remember these, don't make mistakes. Okay, so here this is for fiscal deficit and primary deficit. This data is, here is a larger data. So 9 point, that budget was giving from 9.2 onwards and 6.4, and then the target in the budget is 5.9. Okay, so this you can observe. The bottom one is the primary deficit graph. No continuous increase, no continuous decrease since last 5 years. That is the observation. If you seeing continuous increase, continuous decrease, you can't comment. Okay, because you can see the graph, it went up and it came down. So that is something which you will remember. You know the concept of primary deficit. More importantly, this is important. I hope you are following. If you are following, please put it in the chat. I hope the revision is useful. Yes. Okay, okay. Fine. So then see, earlier there was one question asked on FRBM Act. FRBM, Fiscal Responsibility and Budget Management Act 2003. Okay, mainly this act was mainly to ensure fiscal discipline. Okay, so ensure fiscal discipline. Okay, so ensure fiscal discipline. So fiscal discipline by setting targets, main targets with respect to FD and RD. Okay, so why? Because after 1990, borrowing started increasing. There was high debt to GDP ratio, etc. So to handle that only, mainly. So high debt to GDP. So one is FRBM Act 2003 has fixed targets for 2008-9. Okay, fixed targets for 2008-9. Initial targets, basically what it said, initial target, RD should be made zero. RD should be brought down. RB should be completely made zero. Okay, by 2008-9. Okay, how do you reduce it? Every year, reduce it by 0.5% of GDP every year and get it down to zero. FD target is, they said, you get the FD down to 3% of GDP. Get the FD down to 3% of GDP by 31st March 2009. Okay, by reducing it 0.3%. Minimum annual reduction target was 0.3. Minimum annual reduction target for RD was 0.5. But get it down to zero. RD should be brought down to zero. They could not achieve these targets. They can ask, FRBM could not achieve its targets by 2009 due to main reason, global financial crisis, subprime crisis 2008. And that's the reason we had to follow fiscal stimulus. So that is the reason we could not reach the targets. Okay, so then they may ask this word off budget financing. Off budget financing means government is borrowing and spending, but something that is not shown as part of the government's budget. That is what is called as off budget. So off budget financing was also on a higher side. So government was spending, but that was not shown in the budget. That is called as what? Off budget financing. Okay. Then FRBM targets could not be achieved, and then they came up with FRBM amendments. FRBM Act was amended in 2012 and then 2015. Amendment 2012 and then subsequently 2015. Okay, so they came up with the concept of effective revenue deficit for the first time. In these amendments, they have come up with, oh, the screen got stuck. They came up with effective revenue deficit. 1 second, the screen got stuck. So effective revenue deficit, you can hear my voice. Effective revenue deficit came up. The concept of effective revenue deficit came up in the FRBM amendment. Okay, so notable amendments were there where new concepts like effective revenue deficit was introduced, etc. And they also came up with medium term expenditure framework. Medium term expenditure framework. UPSC asked, medium term expenditure framework was introduced based on the recommendations of FRBM Act, Finance Commission, like that. Answer is FRBM only, medium term expenditure. So there were different documents that are required according to the FRBM. One is the macroeconomic framework statement, we call it as. Of course, what it is, then would have asked, macroeconomic framework statement. Many a times I ask what it is, that's all. Macroeconomic framework statement. Okay. So that means growth prospects of the economy, GDP growth rate, macroeconomy, no? So GDP growth rate, how GDP is growing. So GDP growth rate, along with fiscal balance, how central government is maintaining its fiscal health, etc. And BOP, external sector balance, all these are checked. That is macroeconomic. Then fiscal policy strategy statement. Fiscal policy strategy statement. Okay, fiscal policy strategy statement. So, strategic priorities of the government with respect to taxation, lending, investment, all this is maintained. Okay, then medium-term expenditure framework statement. This was asked. Who suggested? FRBM suggested. One option is FRBM. Simple. UPSC will ask only straightforward questions. Medium-term expenditure framework. Medium-term expenditure framework statement. Okay. So, medium-term expenditure framework statement. So, this is basically a 3-year rolling targets were given. 3-year rolling target for expenditure. Okay, so indicators basically. So 3-year rolling targets, that is the reason we are saying if FD targets of not only 2024, but you are also talking about 25, 26, 27. So 3-year rolling targets for expenditure indicated. So this is what is given. Okay. So then FRBM review committee came up, 2017. FRBM review committee 2017. Okay, it is also called as NK Singh panel. NK Singh. Okay, the committee recommended that the government should target an FD of 3%. Okay, so 3% up to 31st March 2020 and all that. But because of COVID, where is 3%? 2021 it went up to 9.2. Okay, and reduce it to 2.8 and then 2.5. It said come down, bring it down to 2.5% by 2023. Not possible. Because of COVID, all that was not possible. I showed you the budget, no? So the budget target we have seen, 5.9. Okay, so why so much is because already it increased a lot. Okay. Yes. Okay, so then NK Singh committee also came up with talking about the total debt to GDP ratio. So total debt to GDP ratio should not be more than 60%. For central government 40%, both center and state put together, it should not be more than 60. Debt to GDP, borrowings basically. So 20% for state, 40% are center, so it should not be more than 60%. Central government it is 40, debt to GDP, remember. Okay. Then escape clause was mentioned. Escape. So clearly escape clause was not mentioned in the earlier FRBM. It was there. It was hidden. But what is the meaning of escape? You can escape from reaching the target. You can escape from reaching the target. That is what is called as the escape clause. Escape from reaching the target. That is what is called as the escape clause. Okay, so under certain important circumstances, you need not reach the target. There can be a deviation. The deviation can be up to 0.5%. Deviation can be up to 0.5% under exceptional circumstances. Under exceptional circumstances, it is clearly visible. Okay, so certain conditions, for example, like national security issues. National security issues. Okay, act of war. Okay, national calamity. National calamity, like COVID is also national calamity. Okay, or agriculture severely affected. Okay, all this agriculture is, then there can be a deviation of targets of FD and all by a 0.5%. Then structural reforms, if you are implementing structural reforms, then also there can be, you can escape from reaching the target. Okay, or if there is a sharp decline in economic growth, sharp decline in the growth, output of growth, by 3 percentage points. Sharp decline of growth by 3 percentage points below the average, below the average, below the average of previous 4 quarters. Previous 4 quarters. Okay, below the average of previous 4 quarters. If the economic growth is going below 3 percentage points, 3 percentage points below the average of previous 4 quarters. Okay, so these are the conditions. These are the conditions under which escape clause can be there. That is, you can deviate. You can deviate from reaching the FRBM targets. Okay, so this is about the topic fiscal policy, revision of fiscal policy. I hope it is clear. Okay, so the next topic for revision is inflation. Fiscal policy and taxing we have revised. So inflation, okay, so inflation basically persistent rise in prices of goods and services. Disinflation, fall in the rate of inflation. Reflation, rise in prices. Okay. Stagflation, inflation associated with unemployment. Inflation associated with unemployment is what is stagflation. Okay. And then inflation, basically when we use the word inflation, the different types of inflation. Okay, so different types of inflation: cost push, demand pull, structural. Okay. And what we have to remember is the one second. Easy topic, nothing to worry, but only one area which is more important here would be that CPI, WPI, etc. Okay, so inflation can be because of structural problems. Inflation can be cost push, demand pull. Okay, and RBI is inflation targeting. Okay, that inflation target has to be fixed by government once every 5 years, and the target is 4 plus or minus 2 CPI combined. And monetary policy committee will come up with mechanisms to handle or keep the inflation within 4 plus or minus 2. There can be a definite question on inflation because the whole globe was struggling to handle inflation. The whole globe, in fact. So this is basically, you can see advanced economies also. The inflation touched almost like 9.9 in the developing emerging economies and 7.2. And countries like Turkey have touched inflation of 80% also. So because of that, the federal bank has tightened its policy. All other countries across the globe have tightened their policy. So this is something which we should remember. Okay, so important, very important in the sense, since inflation was there across, there can be a question. Okay, so inflation was there there as a challenge. Let me check any other. Give me 1 second. Okay. So now the question comes up, is inflation always bad? Okay, so inflation is never always bad. Okay, certain amount of inflation is always good. For example, when we use the word creeping inflation, okay, I'll write it here. So when we say creeping inflation is always good for the economy. Creeping inflation is something like good. So that is creeping inflation is, the inflation is between 2 to 3%, then it is always good for the economy. Of course, for India, we said up to 6% is also okay. Up to 6 means we said 4 plus or minus 2. That means 2 to 6. Okay. Then we use the word called walking inflation. Creeping is good. So walking is basically inflation between 3 to 10%. Okay. So in India, if the inflation is more than 6 only, we will take it as serious. Okay. So walking is something like 3 to 10, risky. For India, more than 6 also, it is not good. Then we have something like galloping inflation. So when I use the word galloping inflation is inflation something like more than 10%, more than 10, up to 50%, more than 10 and up to 50%. We use the word like galloping inflation. Then the most dangerous is hyperinflation. Hyperinflation, which is also very dangerous because inflation is more than 50%. Inflation more than 50%, hyperinflation, not good. Okay, so Zimbabwe during 2004, Venezuela 2019, in May 2020, Iran also introduced new currency to handle, to tackle hyperinflation. Okay, so hyper is not good. Decent amount of inflation which is good is creeping. The recent past, the most dangerous aspect is all countries' inflation increased. Okay, so in the pandemic period, supply disruptions were there, etc. So essential goods, food, medicines, raw materials, everything became costly. Okay, and also Russia-Ukraine war, because of that also crude oil prices, fertilizers, wheat, sunflower oil. Okay, so all this has led to inflation. All this has led to inflation according to economic survey. Okay, so that is something which you will remember. Okay, and then if we observe, okay, so India's inflation in April 2022 has peaked to 7.8%, which is very high, okay, and above that 6%, and therefore the repo rate has been increased from 4 to 6.5, almost like 250 basis points. 250 basis points, okay. So that is something which we have to remember, okay. And then the different, we can measure inflation using different indexes. So one is the WPI, then we have the CPI. Okay, so WPI inflation. Another one is basic difference between headline inflation and core inflation. When I use the word headline, means you are including everything. Headline inflation means you include food, non-food, everything. It is headline. When I say core inflation means you are excluding volatile aspects. We are excluding volatile aspects. So when I'm saying core inflation, we are excluding volatile aspects like food and oil. Volatile means which are continuously changing. Volatile aspects are those which are continuously changing. Something that is continuously changing, we are calling it as volatile. So volatile aspects like food and oil, when I remove them, then we call it as core inflation. Core inflation. Okay, so when I use the word WPI, wholesale price index, in the WPI index, maximum weightage, 64.2% weightage is given to manufacturing products. You can observe the chart. So WPI, maximum weightage is given to manufacturing products. This is what is important there. Okay, so primary articles 22.6%. Fuel and power 13, manufacturing products 64.2. Most important point is WPI index does not have services. No services. No services in WPI. No confusion. Simple statements will come in exam. Okay, so no services in WPI index. Difference between core and headline should be clear. And in the WPI index component, maximum weightage is given to manufacturing 64.2. Okay, so this is even more deeper segmentation. I've given this chart. Already I've forwarded this chart. Okay, so here economists say if the core inflation is okay, then you need not, so core inflation is stable. If the core inflation is stable, then you need not worry. Okay, if the core inflation is stable, you need not worry. Okay, so that is what economists say, because core inflation is more stable. Okay, but volatile, food is volatile. And WPI inflation is also seen as imported inflation. Why it is seen as imported inflation? Because imports of raw materials, iron, steel, etc., they have a wider impact, no, manufacturing, a wider impact on the WPI index. And that is the reason WPI is called as, WPI is seen as something like imported inflation. WPI inflation is seen as imported. Okay, so it measures the change in the wholesale prices on a monthly basis. WPI measures the change in wholesale prices on a monthly basis. Monthly basis. Okay. DPIIT or earlier Department of Industrial Policy and Promotion under the Ministry of Commerce and Industry compiles and publishes WPI. So there can be a statement straight. Okay. Monthly basis and this. Okay. And then WPI takes 697 commodities, no services, 697 commodities across these, and maximum weighted average. Weightage is given to manufacturing goods. 697. In class I've discussed already 697 commodities. Okay. So that is something which you will remember. Now, WPI inflation increased in the recent past. Okay, specifically they may not ask, this is from the economic survey. This chart is from the economic survey. So here if you see headline inflation means 100%, means everything is included. Okay, so core inflation, here he has not taken food, but core means even oil also has to be excluded. Here he is mentioning core inflation without food. But when in the basics, if it is, what is core inflation? Excluding the volatile aspects like food as well as oil, both. Okay. And here you can see manufacturing products weightage, 64.2. And there is increase. Now 11.1, then reduced to 7.1. So the reasons, economic survey actually talks about the reasons for each aspect, what happened, etc. But I don't think UPSC will ask specifically what happened, why cereals shortage. Okay, in vegetables, tomatoes, there was a problem. Okay, because lack of supply chain issues were there. Okay, like this. Specifically, they may not ask the reasons. That is too much for UPSC. But economic survey mentioned it. Okay, so but WPI monthly basis and no services, maximum weightage 64.2 for manufacturing products, and WPI inflation reduced in the recent past. Okay, so this is something which is sufficient. And WPI inflation can also be seen as imported inflation. Why? Because for every 1% price rise in inflation globally, whenever inflation is increasing by 1%, you will find that WPI inflation in India increases by around 1.63. This is what economic survey says. So they will not ask that. But WPI is seen as imported inflation. That much you remember. Okay, so this is something like some data from the economic survey. But they will not ask this imported inflation should be there. In the current year, global prices of edible oil, rubber, cotton, metals decreased. So that is the reason WPI slowly started decreasing. That is the reason for decline. This is also stated by economic survey. But very difficult, they can't ask that straight statement in the exam. Prelims, they will not torture you much. Okay, so what did government do to reduce WPI inflation? We can blindly think and mark the answer. You need not remember what is stated in the economic survey also. So government basically reduced the excise duty on fuel so that the fuel price will come down. Custom duty also they reduce so that the cost will come down. inflation, WPI. Reduction of import duty, all this they did. Okay, so to reduce it. Nobody can increase it, no, cost will increase. That based on that logic you can mark. You need not remember what they did specifically also. Okay, that is the good thing about UPSC. Okay, next is CPI, Consumer Price Index. So what the final, this is CPI. See, again remember, CPI combined is different, CPI agriculture labor is different, CPI industrial worker is different. So what we are currently using mainly for policy making is CPI combined. So CPI combined means CPI urban plus CPI rural. Okay, and WPI base year, for WPI base year is 2011-12. CPI combined base year is 2012. You can see the first line there. Base year. They can ask that base year in the first statement. See, average annual retail inflation based on CPI combined. Base year 2012 is equal to 100 units CPI. So here, this one, base 2012. Base year is 2012. WPI 11-12. CPI industrial worker, base year is 2016. Okay, so like this, these can come in the statement. These can come in the statement. Now, I'll come to that industrial worker and all, but CPI combined, which we use for policy making and all, no? So at 4 plus or minus 2 CPI, that is this only, domestic retail inflation. So this is also called as retail inflation because finally what the consumer is paying. Finally, what the consumer is paying. So here you have food and beverages as the maximum weightage, 45.9, mentioned in class also, 45.9 maximum weightage. Okay, so food and beverages has the maximum weightage of 45. Food plus beverage put together. And then pan, tobacco, intoxicants is the second category. Third, clothing and footwear, housing is there. Fuel and light, miscellaneous. Miscellaneous has services. Services is there in the CPI basket. CPI basket services is there. WPI basket services is not there. Very important. Okay, and you have you have these 6 entities. In these 6 entities, maximum weightage is given to food and beverages around 45.9%. Okay, so that is one observation there, very important observation. Okay, core inflation, food inflation here he has given. So now reasons again, multiple reasons what happened, why food related, what happened, food shortages, milk became costly because animal feed became costly. Like this, multiple reasons are there. So in the economic survey, very specific reason why milk became, animal feed was becoming costly. But I don't think UPSC will ask. I don't think 99.9% they'll not ask that. So they may ask CPI combined what happened, but specifically why milk became costly, nobody will ask. Okay, so now here you have headline, core. Okay, so headline and core basic understanding is clear. Last year economic survey, 2 years back, they came up with refined core. CPI refined core. That word last year, nowadays this is a fashion, no? They'll ask what new terms came up before last year. So CPI refined core was asked. What core means what? Excluding food and oil. Okay, refined core means there are some services which also use oil as the raw material. For example, transportation is a service. So transportation also uses petrol, diesel. So those services which are using oil as the raw material, etc., you are excluding them also. Then it is called as refined core. CPI refined core. Okay, so earlier economic survey was talking about refined core. This data is this year economic survey. There is no discussion of refined core. Okay, so here we are only talking about CPI headline, CPI core, that's all. There is no discussion of CPI refined core here. I think it is clear. Okay, so now when CPI basically measures the change in retail prices on a monthly basis, monthly this also, and it includes both goods and services. Goods, okay, and you have rural separate, urban separate. When this is combined, this weightage is mainly combined. CPI combined means CPI rural plus CPI urban, both put together. Okay, so both put together, that is CPI combined. Okay, Now, okay, there are other indexes also. Just you will remember, there is something like CPI industrial workers. They are not using it much. Okay, so this CPI industrial workers is basically compiled by the Labor Bureau under the Ministry of Labor and Employment. Okay, so they're not using, IW is industrial worker. But what you will remember is for this CPI industrial worker, the base year has been changed in the recent past to 2016. So for deciding salaries, etc. for industrial workers, they will compare it with CPI industrial worker. CPI industrial worker. So CPI industrial worker base year is 2016. Okay, CPI combined. Okay, CPI combined as of now, which we discussed. No, this one CPI combined, which is given by CSO, Central CSO. Now it is part of NSO. Okay, the base year is 2012. 2012. Okay, so since CPI industrial worker is changed now, so recently they may ask base year 2016 for industrial. Don't get confused, no. Sir, you told CPI combined no, combined, CPI combined 2012 only. CPI industrial worker separate 2016. There is also CPI agriculture labor also separate. 1986-87 is the base year. But I will not think they will ask that because that is not changed recently. So what is changed recently? CPI industrial worker. So whose base year is changed to 2016. Okay. This again is a bifurcation of CPI only, but urban basket separately, rural basket separately. Now this you can't remember everything. Okay, so food and beverages both put together was something like 45.9. 45.9. Okay, now here it is rural urban separation. Okay, so what you can remember is one thing, housing services, no, it's not there in rural. Why? Because rural area, everybody will have that kacha house. Okay, so rural it is, housing is not there, urban it is there. Okay, and then you can see food more weightage in rural in comparison to urban. Okay, food weightage you can observe there. Okay, so, and clothing, footwear, okay, fuel and light also rural more. That means they are more sensitive. You may say, sir, fuel, urban use more, but who is more sensitive to fuel? Rural, spending more. If you have to spend from their little income, they have to spend more on fuel and light. That's why that weightage for rural is more. So one takeaway only, So one is food is more, weightage for food is more in rural. Separate, this is separate wala. We have seen combined, no, combined that this is have separated both, rural separate, urban separate. Okay, so this you need not remember, but economic survey says the gap between rural and urban inflation has reduced in the recent past. This you remember. The gap between rural and urban inflation has reduced in the recent past, 2022-23. So gap between rural and urban inflation reduced. And in most of the states, rural, 22-23, most of the states, rural inflation was more than urban. Rural inflation was more than urban in most of the states, 22-23. Food and all was the problem. Food did not reach the rural areas fast. Okay, imported food reached urban areas fast. Okay, so that is basically some and gap between rural urban inflation reduced. Okay, you need not remember the graph also. Gap reduced in the recent past. In March it was highest, it reduced. This is what you need not read the graphs. So that is a takeaway from the graphs in the economic survey. Okay, so takeaway. Now, economic survey also says gap between WPI inflation and CPI inflation reduced in the recent past. Gap between WPI inflation and CPI inflation reduced in the recent past. Okay, so that is one more important aspect is that means WPI was more than CPI. If he's giving CPI is always more than WPI, that's nonsense. I'll show you the graph. No, WPI was here, CPI was here. Okay. And by December 22, WPI went down, CPI increased. There was this gap reduced. There was a merge. This is CPI, bottom. This is CPI, this is WPI. WPI reduced, CPI increased, both touched. Okay, 2022. Okay, so that happened. Okay, so here this is the graph in the economic survey. Convergence of WPI and CPI. The top line you see, no, top one is WPI. Just observe, I moved aside. Just observe the graph. WPI, the top one is WPI. Okay, by November 2022, by December, you can observe there, WPI and CPI merged. CPI increased, WPI decreased. WPI, there was a decrease. So WPI inflation was continuously increasing in the last 1 year, last 2 years. No, WPI inflation reduced because government took measures, imported products, iron, steel, etc. That duties were reduced, so WPI reduced. And services started becoming costly slowly, and CPI increased. And that is how there is this merge. This is what economic survey says. Okay, so one more measure of inflation is GDP deflator. Okay, GDP deflator, but we don't use that much. So GDP deflator is nothing but nominal GDP divided by real GDP into 100. Okay, what is the difference between CPI? Why GDP deflator is not taken for measuring inflation, though it is more comprehensive? This is what is GDP deflator. Nominal GDP by real GDP into 100. Nominal GDP is GDP calculated at current year prices. Real GDP is GDP calculated at base year price. Okay, nominal GDP, if I have to quote the differences between GDP deflator and CPI, quote the differences between GDP deflator and CPI. Okay, so GDP deflator basically is more comprehensive because you're taking all goods and services. But the data is not available on a monthly basis. So quarterly basis also you can calculate, but it comes with a lag. Lag will be there. And imported inflation is not covered in GDP deflator. Imported inflation. Why? Because what is the definition of GDP? Total final value of all goods and services produced within the domestic territory of India within one financial year. Within domestic territory of India means imported aspects inflation is not covered under GDP deflator. So one is the lag, another one is this imported inflation. That is the reason for policy making we are not using GDP deflator. We are using CPI combined for policy making now. I hope it is clear. Students, you are able to follow. Not more than this is required for inflation. What they will ask? They will not ask directly, what happened, because what are the reasons. One logical, simple question they will ask, which we can mark in the exam. Very simple question they will ask. Inflation, what reasons, what should be done to reduce inflation, that this. Okay, CPI monthly. Okay, what is there in the CPI basket, maximum weightage to given to food. Like this only. UPSC will ask that only. That you revise. Don't waste in reading unnecessary things. Okay, better you can revise polity or other subjects. Okay. So GDP deflator, I think it is clear. See, economic survey economic survey came up with a comparison between inflation in 1973. That time the highest inflations were seen across the globe because of oil crisis. OPEC countries were responsible. And what is the current inflation which we see? So it made a comparison. So that time inflation was mainly because of oil only. Okay, so you can see economic survey. One simple question they may ask, if at all they have to ask from the economic survey, current inflation and inflation in 1970s. Okay, so current inflation, smaller rise. That time inflation is too much. This time it is okay, manageable even for US also. 9.2 is manageable for US. Earlier the inflation was very high. And that time inflation was mainly because of oil prices. Here it is not just because of oil. Oil is only one of the factors. Agriculture goods, fertilizers, metals, many are there. Okay. Demand pull is there, cost push. Both are responsible. Okay. So when we talk about current inflation. But that time it was mainly because of supply chain disruptions. OPEC countries decided to increase the oil, not to supply, finish. Okay, so inflation 1970s took place against the backdrop of steadily rising world inflation. Okay, so it took very long time to reduce that inflation in 1970. Now this is not like that. We were able to handle it. This is a basic differentiation. It is there in the economic survey. Okay, so so we'll complete inflation another 5-10 minutes, and then I will give you a break. Okay, so break, you eat something, maybe you can have some tea or something. So because I will drag the class till another, I'll not give half an hour breaks. Okay, 10-15 minutes, take a break, have some tea or whatever it is, and then we can complete one more topic. Let's see. Okay, so here, this is not taught in the class and all, because this is specific to economic survey. So in the economic survey, there was this discussion of National Housing Bank, which has published 2 housing price indices. Economic survey specifically talks about increasing prices in the housing sector and pharmaceutical sector. Specifically it mentioned, I don't know, insurance, and whether they will ask, if at all they ask. So one, it was mentioned like housing price index, okay, housing price. So National Housing Bank has published 2 housing price indices with financial year 2018 as the base year. Okay, so one is called as the housing price index market price, and another one is the assessed price, or you call it as the assessment price. Okay, so market price is basically at price at which the property will be sold in the open market. That is what is market price. Assessed price is value assigned to a home or other piece of real estate for property tax purposes. Property tax purposes. It takes into account the value of properties in the area among other factors. So here if you see overall increase, you could see an overall increase in the housing price index assessment. Okay, this shows that there is increased demand in the housing finance. That is, there is demand for houses, there is demand for loans and all that. That because it shows that the housing price index is increasing. Okay, so there is a stable to moderate increase with housing price index, and this housing price index is given by National Housing Bank. That much you remember. National Housing Bank. If you don't remember a market price, assessment price also, it's okay. Okay, so at least remember these HPI index is given by National Housing Bank. And economic survey says there is increased demand, so now inflation is there. Okay, so some graphs it gave, but insurance. Just checking anything important. Okay. That's all. Okay, that is about inflation. Any other words left out after the break? Okay, so students, you are able to follow and able to revise. Put something in the chat that you are able to follow and you are able to revise. Is it okay? Respond, please, so that I'll get to know, because this is about inflation along with economic survey, whatever required we have covered. Okay, so I hope you're able to follow. So take a break. Take a break of 10-15 minutes. So it's 6:55. By 7:10 at least, 7:10 at least we'll start. Okay, so take a break and come. We will start with national income. We'll finish off national income also. I think national income, WTO is there. Let's see, national income will be over, but WTO is huge. You need to be very alert for WTO. Okay, that's all. So take a break. We'll meet at 7:10. Yes. Uh-oh. Oh, okay. So, uh, so the topic is national income, growth, poverty, unemployment, etc. That would be a different topic. This is purely we'll be focusing on national income only. Okay. Give me 1 minute. National income, what are the main areas? Okay. So here some questions are there where they may ask you some basics of microeconomics. Some basics only which we discussed in our basics class. For example, so first thing is law of diminishing marginal utility. Okay, so suppose this is also one of the main aspect that will decide the demand curve. Okay, so as simple as that. So this is also called as law of diminishing marginal utility. So utility is nothing but satisfaction. Utility is nothing but satisfaction. Okay, so satisfaction is measured using the principle called utils. Okay, so one is we have the marginal utility, additional, marginal is additional, and then we have the total utility. So what is marginal utility? It is a total satisfaction, that is the satisfaction that is derived from consumption of additional unit of a commodity. What is the satisfaction that you are getting by consumption of additional unit of a commodity? That is what is called as marginal utility. Okay, so total satisfaction derived from consumption of given units of commodity total. For example, now, how does this operate now? Simple way to understand. Suppose I am eating ice creams. Now here I am taking number of units of ice cream consumed. This is utils, unit for satisfaction. This is marginal utility. This is total utility. So when I am eating the first ice cream, the satisfaction I got, utils, 10 utils. Total utility is also 10. Okay. Second ice cream, my satisfaction reduced to 7. Wantedly God has kept this. Otherwise, no, everybody will become too greedy. So in spite of that, we are very greedy. So automatically your marginal utility or satisfaction is coming down. Second ice cream. Okay, now what is the total satisfaction of these two units? 10 plus 7, 17. Third ice cream, it becomes 5. Further reduced. Total utility 10 plus 7 plus 5, 22. Fourth ice cream, it became almost 3. Okay, so marginal utility. So it became 25. Fifth ice cream, nothing. No utility. Then sixth ice cream, negative. Okay, so it becomes 15. So when we consume more units, marginal utility decreases. As simple as that. When we consume more units, marginal utility decreases. This is what is law of diminishing marginal utility. Okay, so units are increasing. Okay, marginal utility is decreasing. So if a consumer is consuming more and more units, the satisfaction derived from each unit, satisfaction derived from every additional unit is going to decrease. So this is the basic fundamental aspect for the basic demand graph. When I talk about the basic demand graph or the law of demand, so here I will take quantity demanded and here we are taking price. Okay, so we know that this graph is basically a rightward sloping graph. Rightward sloping graph. Okay, so now the question is, at this price, this is the quantity demanded. Okay, and when the price is increasing from P1 to P2, quantity demanded has reduced. So there's an inverse relationship between price and quantity demanded. This is a regular law of demand. Okay. At the same price, when my income increases, at this price P2 only, if my income increases, I'll be ready to purchase more. At the same price P1, I'll be purchasing more when my income increases. Similarly, when my income increases at this level, I'll be able to purchase more. That means when my income increases, there will be a rightward shift with respect to my demand graphs. Rightward shift. Because at the same price, I'll be able to consume, I'll be interested in consuming more. I want more. I'll be able to consume more because, as simple as that, because I have the paying capacity. I'll buy more. So, rightward shift of demand graph will indicate favorable demand. Rightward shift of demand graph will indicate favorable demand. Leftward shift of demand graph will indicate unfavorable demand. Leftward shift will indicate unfavorable demand. Okay, but there are also exceptions to the demand graphs. Exceptions. One exception. Okay, so one exception of the demand graph is the inferior good. So inferior goods are an exception to regular law of demand. Inferior goods are an exception to regular law of demand. Okay, and similarly Veblen goods are an exception to regular law of demand, and also Giffen goods are an exception to regular law of demand. So inferior goods, okay, as my income is increasing, quantity demanded of these goods may decrease. Okay, so for example, nano. So income is increasing, people may shift from nano to alto. Okay, so because there is a substitute available. And that is the reason. So inferior goods are an exception. They are an exception to regular law of demand. Exception to regular law of demand. Veblen goods are status-oriented goods. As the price increases, quantity demanded also increases. These are status goods. You are buying them because the price is more and it differentiates you from the sheep. So, for example, Bentley cars or maybe gold, precious items basically. Okay, so Veblen goods are also an exception to regular law of demand. As the price increases, quantity demanded is also increasing. Okay, Giffen goods are also an exception to regular law of demand. Price increases, quantity demanded also increases. But Giffen goods are not luxury items. They are also a kind of inferior only. They are a subset of inferior goods. But there are no substitutes. For example, in certain places like Northeast, etc., there's huge demand, let's say, for potatoes. The price of potatoes is increasing, still demand for potatoes is increasing because there is no availability or substitute for potato. So these Giffen goods are a subset of inferior goods and they are also an exception of regular law of demand. Okay. Now, when we talk about a demand and a supply graph, okay, so here I am taking quantity demanded and quantity supplied together. Okay, I am taking price here. Okay, so this would be my demand graph. Okay, and this is the supply graph. Okay, this intersection point, this is the point of equilibrium. So this is called as theory of market equilibrium, basically given by Adam Smith. So when there is more demand, there will be again a rightward shift with respect to demand graph, and this will be the new intersection point. So this will be the new price. So inflation, price increases with increase in demand. Okay, so this is basically called as theory of market equilibrium given by Adam Smith. Okay, given by Adam. That much should be clear. Okay, so when it comes to UPSC, specific questions on these things will not be asked. So when we talk about supply graph and demand graph, so this is the supply graph, you can see S, and the D is the demand graph. Okay, and these are the basic fundamentals which we should know. And when we talk about demand, supply, etc., these are the factors that are responsible for deciding the demand or the output in the economy. So when we are talking about national income, okay, or when we use the word, there are different aggregates used for measuring national income. 8 aggregates are there for measuring national income. So 8 aggregates: GDP at factor cost, GDP at market price, GNP at factor cost, GNP at factor market price. Okay, so different aggregates are there. GDP at factor cost, GNP at market price, GNP at factor cost, okay, NNP at market price, NNP at factor cost. Okay. NDP at market price, NDP at factor cost. So total 8 aggregates are there. You don't have more than 8. So through 8 aggregates only national income can be measured. Earlier, national income was measured at factor costs. So after 2015, national income is measured at market prices. So after 2015, national income is measured at market prices. National income is measured at market prices. Okay. So when I use the word GDP, first thing, when I use the word GDP, okay, it is the total monetary value of all goods and services produced within the domestic territory of India in one financial year. And it is calculated by National Statistical Office on a quarterly basis as well as annual basis. Okay. So GDP can be measured at market prices or at factor cost, number one. And then there is something called as the nominal GDP and the real GDP. When I say nominal GDP, this is the GDP measured at current year prices. Current year prices. Real GDP is a GDP measured at base year prices. When I use the word base year is a reference year for making comparisons. That year without much of fluctuations, very high growth nor very low growth, is taken as the base year. Okay. Remember, when I use the word national income will only include productive income. Productive income. That means unproductive income or transfer payments, unproductive or transfer payments will not be part of national income. So remittances, grants and all that will not be part of national income, though they are part of my personal income. Though they are part of the personal income, they are not part of the national income. Okay, so that is something which you should remember. Okay, so in the circular flow of income, you know the circular flow of income. That is a basic methodology of measuring national income. Okay, so we can measure it at using GDP can be measured using consumption method or the expenditure method, or it can be measured using income method or the product method. So consumption method or expenditure method, so it is measured using the formula C plus I plus G plus X minus M. C is the consumption, I investment, government spending, X minus M is NX or net exports. Okay, this should be clear. Okay, then national income can also be measured using income method. Income method. So earlier income method formula was something like Viper. Wages plus interest plus profit plus rent. But now there is a new formula which they are using for measuring national income using income method, that is operating surplus plus mixed income plus compensation to employees. Operating surplus plus mixed income plus, so operating surplus can be profit plus rent plus royalty, profit, rent, interest. All this can be seen as operating surplus, profit, plus rent plus interest. Okay, in the class we have discussed what is mixed income, income from different sources. So this is how using income method, mixed income plus C is what? Compensation to employees, like the wages. Okay, so mixed income, income from more than one source. Okay, and then we have the product method, or we call it as the final output. So product method, again there are two in this. One is the GVA method, gross value addition, and another one is the final output method, GVA or final output. Okay, so when I talk about gross value addition, so gross value addition is nothing but value of output, that is value of output minus intermediate consumption, value of output minus intermediate consumption, value of output minus intermediate consumption. Okay, so that should be clear, value of output minus intermediate consumption. Okay, so then in the basics class and of course in the national income class, we would have discussed something like, okay, so whenever we are using the word domestic territory for GDP, that domestic territory will not only include the physical boundary of the country, this will also include military establishments, embassies and consulates in other countries will be part of the domestic territory for calculating GDP. Similarly, fishing vessels, aircrafts, etc. all fall under the domestic territory. So that means Air India is moving up to US and there are some sales happening, etc. So that whatever is happening in Air India is also part of India's GDP. So that is basically fishing vessels, ships, etc. All that is going to be part of India's GDP. Okay. So then market price and factor cost. Okay, so we all know market price is equal to factor cost plus indirect taxes minus subsidy. Okay, or market price is equal to factor cost plus net indirect taxes. Net indirect taxes. No confusion, basic formulas. Remember, transfer payments are not part of national income calculations. So obviously GDP at market price will be equal to here. Okay, GDP at market price will be equal to GDP at factor cost plus net indirect taxes. Net indirect taxes. Should be clear. Okay. Then transfer payments. Remember transfer payments. Transfer payments are not part of national income calculation. Don't forget. Not part of national income calculation. Okay. So then domestic versus national. So domestic versus national. So that is basically when I say GNP, gross national product, is equal to GDP plus NFIA, net factor income from abroad. Always GNP need not be greater than GDP. GDP can be greater than GNP also based on net factor income from abroad. Remittances are not NFIA. Remittances will not be part of NFIA because remittances are transfer payments. They are not factor incomes. Okay, so factor in remittances will not be part of NFIA. NRI income will not be part. NRI income will not be part of GNP because here when we are talking about GNP and GDP, so we are talking about the total final value of all the residents of India. So residents of India within the country and outside. So that is the definition of GNP. Okay, residents of India within and outside. NRI is non-resident Indian. So many times people get confused. They say, no, in Ramesh Singh it is like this. Okay, in Brunel blog it is like this. No. So non-resident Indian, non-resident. Okay, so when I use the basic definition of GNP, total final value of all goods and services produced by the residents of the country, residents of the country from within and outside the territory, residents of the country from within and outside the territory in one financial year, one financial year. Okay, so that is what is the definition of GNP, based on which you should know that NFIA does not include remittances, and GNP NRI income also should not be part of GNP calculation, because NRI is non-resident Indian there. Okay, so that should be clear. Okay, and what is domestic, resident, non-resident, we have discussed earlier. Okay, so that should be clear. There should not be any confusion there. Okay, now the 2015 basically GDP calculation, 2015 GDP calculation, there is this change which they have brought in. So 2015 CSO has come up with certain reforms. The reforms which CSO has come up with, one is shifting of base year from 4-5 to 11-12. That was one change. Base year shift from 2004-5 to 11-12. Okay. Second is GDP calculation shift from factor cost to market price. Factor cost to market price. Okay. Then they have also come up with the concept of GVA at basic prices. So GVA at basic prices will be in between factor cost and market price. They came up with the concept of basic prices. Okay, and basic price will be in between factor cost and market prices. Okay, so GVA at basic prices will be equal to GVA at factor cost plus net production taxes. Net product. There are no product taxes. So what is the net production taxes? Production tax minus production subsidy. So it is GVA at factor cost plus production taxes minus production subsidy. Production taxes minus production subsidy. Okay. From here, if I want to arrive at GDP at market price, it is equal to GVA at basic price plus net product taxes. So GST is a product tax. Okay, so this is equal to GVA at basic price plus product tax minus product subsidy. Remember, product taxes, production taxes and product taxes difference should be clear. Okay, so production taxes are those taxes which are independent of production volume. Production taxes are those taxes which are independent of production volume. Similarly, production subsidies are those subsidies which are independent of production volume, fixed amount of subsidies. Okay, so that is what is product. GST and all is a product tax. Okay, that should be clear. Okay, now, though we know the national income, how do we arrive at personal income basically? Okay, so national income is known, but personal income, there is a difference between personal income and national income. We have discussed, there is this chart, just show you the chart. Okay, so suppose we have the national income. Let's say NNP at factor cost is seen as national income. Now, of course, national income is calculated at market prices. So from NNP at factor cost, okay, so if I have to arrive at personal income, so that is from NNP at factor cost, we have to remove undistributed profits. So undistributed profits or retained earnings is not getting distributed. It is not getting distributed in the form of rent, nor wages, nor interest. So therefore, that is not going to be part of personal income. So this undistributed profits or retained earnings has to be removed. Similarly, corporate tax payment is also not getting distributed in the form of rent or wage to the household. So therefore, from the national income, we have removed undistributed profit, retained earning. From that, we have removed corporate taxes. And from again, we have removed net interest paid. Net interest paid. Net interest paid. Suppose loan has been taken, you're paying it to SBI, etc. So net interest paid. Okay, so from national income, we have removed undistributed profit, removed corporate taxes, we have removed net interest paid. But something that is not part of national income is part of personal income. What is that? Transfer payment. So I have to add transfer payments, then I arrive at personal income. Once we arrive at personal income, from the personal income, we have to remove something like the taxes, the direct taxes, etc. and fines. Then we arrive at personal disposable income. We arrive at personal disposable income. So transfer payments are not part of national income, but transfer payments are part of personal income. Transfer payments are part of personal disposable income. They are part of personal income and they are part of personal disposable income. Should be clear. Okay, so this we have done it through drawing some box. We said, yes, from the national income, undistributed profit is retained by the firm only, not getting distributed. Similarly, you have net interest paid going to the bank. Similarly, corporate taxes are going to the government, not getting distributed. So from the national income, these three should be removed. But personal income includes transfer payments, because personal income includes both earned income and unearned income. National income will only include earned income or productive income. So unproductive, unearned income is not part of national income. It is part of personal income. So based on that logic only, okay, so we have to arrive at something like the personal disposable income out here. Okay, so when we have to understand, so here transfer payment not, so here in national income, transfer payment is not included in the national income. Okay, it includes both, okay, earned income and transfer receipts. Both are included. Transfer receipts are included here. Okay, so undistributed profits of companies, corporate taxes, okay, so are not undistributed profits not included, undistributed profits are not included, corporate taxes are not included, they are not part of the personal income, observe, okay, but they are included, these things are included in the national income. That's the reason I had to deduct them. Okay. Now third one, this CAPF they have asked, UPSC till now has not gone to this level now, UPSC prelims did not ask. Interest on national debt. Interest on national debt is included in personal income. Interest on national debt is not part of national income. So that means government is issuing some bonds, raising money to bridge deficits. Okay, government has issued some bonds, raised money to bridge deficits. But it has not produced anything. good or service. So, but those who have purchased these bonds, they are getting that interest. So this interest is not seen as income for them. It is not seen as income. This interest which they are getting on the national debt, okay, this interest which they are getting is seen as a transfer payment, because in return there is no good nor service that is rendered. So government has raised money, but it did not use it for any productive purpose. It has used it for bridging deficits. So that is what is interest on national debt. Otherwise, generally interest is what? If interest is not a kind of a transfer payment, no, interest is generally a income. On loan, okay, on capital there is interest, so it is part of factor income. But this interest is different. This interest on national debt, where the government is raising money but not using it for any productive purpose, then that interest on national debt is seen as a transfer payment, and therefore it is not included in the national income, but it is included in the personal income. That is what you will remember. Okay, so that is something which you have to remember. Okay, now when we talk about measuring GDP, so GDP can be measured at PPP also. So purchasing power parity prices. So when we are measuring GDP at purchasing power parity prices, so we have discussed PPP, purchasing power parity. So when I use the word PPP, okay, so this PPP, you are taking a basket of goods, you are comparing this basket of goods in one country, that is US, and the same basket of goods you are comparing it with in India. Okay, so that is basically called as $1. Suppose you are taking a basket of goods, and this basket of goods is costing 30 rupees in India. Similar basket you are getting it for $1 in US. Now PPP exchange rate is $1 is 30. Of course, I will discuss this in the external sector, revising external sector tomorrow, not today. So tomorrow we will see that, not today. Okay, so external sector. Okay, so tomorrow we will discuss. Okay, that don't worry about that. No. Okay. So that is about per capita income, etc. Okay, total national income by total population. Per capita income is total national income by total population. Okay, so in mains there was one question asked in UPSC, but this time they can ask the same question in prelims. Okay, so in mains they've asked this question, but prelims the same question can be asked. That is nothing but potential GDP. So what is potential GDP, they have asked in the mains. So they can ask the same question in prelims. So anybody who knows this, put it in the chat, let's see, as a relief basically for you. So what is this potential GDP, anybody? If you know, put it in the chat. Yes. Okay. Somebody is writing something. Let me see. Capacity of such production. Okay. Increase in GDP along with inflation. Who told? What is that? Increase of GDP along with inflation? No, no. No. Capacity of production, capacity, increase in GDP. No, not like that. So the word, first of all, in exam, no, whenever you get some words like that, so go by the English meaning first. No, if you don't know anything, no, options are anyhow given. So what is the potential of achieving the GDP? No, that is something you are talking about future. No, so future, that is futuristic. Futuristic potential. What is the potential of India with respect to achieving its GDP? Isn't it? That is what is potential GDP. So from that you will get some clue actually, though you don't know what it is. Okay, for example, last year there was some question suddenly came up, what is real sector? Okay, so real sector is that sector like the manufacturing and all, there is real output, which is supported by non-real sectors like banking, insurance, etc. So like this, out of the way, you can come across a term which you have never seen earlier. It happens. So that you should be very cautious. Okay, fine. So it is the real value of goods and services that can be produced when countries, all factors of production are working at its full potential, are fully employed. So what would be the real value of goods and services that can be achieved? Real value of goods and services that can be produced when countries factors of production are fully employed. You know what is factors of production? When countries factors of production are fully employed. Okay, so that is what, if the country's factors of production are working at its full potential, okay, so the GDP which it is about to reach. So potential GDP will be different from actual GDP. So obviously all countries' full factors of production will not be at its full work, no? So if countries' factors of production are at its peak potential, working fully, what is the GDP it can achieve? So that is what is called as the potential GDP. Okay, so potential output, okay, so it depends on several factors. So technological factors, etc. Okay, political setup, infrastructure, everything. That also plays a role. But he may ask, what is potential GDP? No, potential GDP is GDP that a country can achieve when all its factors of production are working at 100% efficiency. Okay, so that is basically what is potential GDP. One second. Just looking for anything in the economic survey or in the budget, any trend. Give me 1 second. Okay, see, this question gives a clarity. GDP growth, national income. So one is concepts only, but with concepts alone, sometimes you will ask this. Okay, so with reference to economic survey, which one of the following statements is not correct? Observe it very carefully. Not correct, you know. India is the highest remittance receiving country in the last 2 years. Yes, India is #1 with respect to remittances. Okay. So India is the third largest economy in the world when it comes to, when you are measuring it through PPP, purchasing power parity exchange rate. Yes, third largest. But when we are measuring it through nominal exchange rates, that is $1.70, whatever it is, India ranks fifth largest economy. US, China, Japan, Germany, and then India. Okay, but when it comes to purchasing power parity, India ranks 3. Okay. And with respect to forex reserve, obviously India is not the largest foreign reserve holder. China, basically. India ranks around 4. Okay, so this is something like one statement can be a concept. Second statement, you know, it will not be a concept. It will be something like this fact. So these are the right facts which you will remember. You know, that is third largest. So third largest economy in the world with respect to PPP. Okay, fifth largest with respect to the market exchange rate. Okay, highest remittance receiving country. And India is not the largest forex reserve holder, China basically. Okay, so like this every time question comes up. Okay, so then we so here economic survey again. So economic survey, economy exhibits a higher degree of openness. So we use the word open economy, closed economy, okay. So closed economy means where there is no trade. Open economy is where there is trade. Okay. Economy exhibits a higher degree of openness if there is a higher foreign trade as a proportion of GDP. That is what you will remember. So higher degree of openness if there is a higher foreign trade as a proportion of GDP. Higher foreign trade as a proportion of GDP. Remember. Okay, that is what we should know. And economic survey also talks about credit to GDP gap. Okay, so credit to GDP gap. Okay, so here it is a difference between credit to GDP ratio and its long-term trend. What is the role of loan credit in terms of pushing GDP? So that is what is credit to GDP gap, which was asked in the, this is purely economic survey, purely direct pickup from economic survey. Okay, so it is difference between credit to GDP ratio and its long-term trend. Okay, and higher credit to GDP ratio indicates that active participation of banking sector in the real economy. Now, in the real economy, what is real sector was asked, manufacturing, etc., agriculture producing output, all this is real sector. This was asked last year, what is real sector? So like this, from our terms, there can be some option which can come up in the exam. So very carefully you have to prepare. So difference between credit to GDP ratio and its long-term trend, that is what is credit to GDP ratio. And then higher credit to GDP ratio indicates active participation of banking sector in the real economy. So it's it on the board. Okay. Okay, that's it. Okay, so now let's revise. This is a typical topic. No questions only. We'll not solve any questions here because it's mains plus prelims, huge area. Huge. This is huge area. So tomorrow we can do poverty and development. Okay, poverty and development means growth and development, where poverty, unemployment, growth, human development index, that index, this index, that is there. And then we have money market, capital market, okay, share market related areas. Then international institutions, if you have discussed, I will not touch because World Bank and all you have discussed in your international relations class, then I will not touch. If it is not touched, then we'll revise World Bank and IMF also. Like, of course, not everything. We can only touch what can be asked, basically. And then we'll also look into areas like agriculture, etc. But today, let's see. See, WTO, you would have read WTO, and it's little difficult, basically, to revise at a faster pace. Revising WTO is not so easy. Okay, and maybe one question may come, maybe, and many a times from where, I will tell you from where question will come. So from where question can come, one area where question can come in WTO is TRIMS, trade related investment measures. Okay, There can be question on dispute settlement mechanism because it was in newspapers. Dispute settlement mechanism. There can be question on the recent Geneva conference. What was the crux of the recent Geneva ministerial conference, they can ask. Okay, and maybe TRIPS or agreement on agriculture. These are the areas where question may come. Okay. So WTO is a result of Bretton Woods conference. So during Bretton Woods, the main purpose of Bretton Woods conference, 1 minute. So main purpose of Bretton Woods conference was to revamp the developed world, which were hit because of war, Second World War. So because of that, they have suggested Bretton Woods conference, and in the Bretton Woods conference, many institutes like IMF, World Bank, and International Trade Organization, everything was suggested. IMF and World Bank came into existence as a result of Bretton Woods conference, and they are also called as Bretton Woods twins. But ITO, International Trade Organization, did not come into existence, and only an agreement called GATS came into existence. General Agreement on Trade, General Agreement on Trade and Tariff came into existence in 1948. Okay, so multilateral trade negotiations were held under GATT, but the 8th multilateral trade negotiation was between 1986 to 94, which is called as the Uruguay Round. And this Uruguay Round was mainly responsible for the discussions of several aspects that came to the forefront, whether it is services related, intellectual property rights, all that. So after the Uruguay Round, there were several issues of conflict between developed and the developing world. And because of these issues of conflict, a Dunkel draft was prepared. So in this Dunkel draft, Sir Arthur Dunkel was the head Director General of GATT at that point of time. So he created a Dunkel draft. And this Dunkel draft had all the issues related to agricultural subsidies, intellectual property rights, investments and all that. And this Dunkel draft was put to vote at a place called Marrakesh, Morocco basically, Marrakesh Agreement we call it as. India was a founding member, India was also there part of it. So this Marrakesh Agreement was mainly responsible for WTO formation of WTO in 1995. So WTO is an organization, but GATT, General Agreement on Trade and Tariff, was only an agreement. WTO had a dispute settlement body. GATT did not have a specific dispute settlement, though it was there, but it was not so strong. Did not have a specific dispute settlement body. So this multilateral organization called WTO promotes multilateral trade, or promotes multilateral trade between more than two countries. But when we talk about free trade, okay, free trade is for the benefit of everybody. This is what Adam Smith, David Ricardo, these are capitalist thinkers who feel. But Prebisch-Singer hypothesis, which we discussed already, says free trade may not be for the benefit of everybody. That is what is Prebisch-Singer hypothesis. And under WTO, there were several agreements. So if we see the structure of WTO, the highest decision-making body under WTO is the Ministerial Conference, which generally has to meet once every 2 years, at least once every 2 years, the Ministerial Conference. The first Ministerial Conference took place in Singapore, and that is called as the Singapore Ministerial Conference in 1996. And the most recent Ministerial Conference took place in 2022, basically, which is called as the Geneva Ministerial Conference. Okay, so from the formation of WTO, okay, so there were several ministerial conferences held. They were discussing on several important issues, etc. So all the ministerial conferences you can't remember, but you have to remember few like the Doha Ministerial Conference, Bali, Nairobi, and the recent Geneva. Now, when it comes to the structure of WTO, the highest decision-making body in WTO is Ministerial Conference, which generally meets once every 2 years. Then if once every 2 years means, suppose if every month there's a new thing that any decision has to be taken, then who will take that decision? So under the Ministerial Conference, you have the General Council. So General Council is an executive body of the WTO, which generally means once every 30 days, and this General Council takes the decisions if on a regular basis. And now the same General Council reassembles itself as a dispute settlement body and also a trade policy review body. But the biggest challenge in the recent past was mainly with respect to this dispute settlement body. Main challenge in the recent past was mainly with respect to the dispute settlement body. Okay, so the dispute settlement body, what was the main problem with respect to the dispute? So there is an appellate authority or the appellate body which has 7 judges. So since WTO, the decision making is based on consensus, and US was blocking the reappointment of these judges in the dispute settlement body. US was blocking the reappointment of judges in this appellate body. So you don't have 4 judges at least sitting and giving judgments, then you can't appeal to the appellate body. So that is how US was creating problems with respect to the dispute settlement mechanism under WTO. So that's not good because the main entity under WTO, which is the dispute settlement mechanism, was mainly getting dismantled because of US blocking the reappointment of judges in the appellate body. Appellate body is something like the judgment comes up from the dispute settlement panel, you can go and appeal in the appellate body. So that was becoming difficult. Okay. Now, that should be clear. Till here, things I think it is clear. Okay. So moving forward now. So there are different principles of WTO, but the question will come mainly from the first principle of WTO, that is the trade without discrimination. So trade without discrimination has only 2. One is the principle of national treatment and the most favored nation. Remember, national treatment concept will be applicable only to those entities only after the goods have entered the domestic territory. Remember, national treatment will be applicable only after the goods have entered into the domestic territory. So that is basically national treatment. Are there exceptions to national treatment? Yes, there will be exceptions. Okay. So remember, levying customs duty is not a violation of the principle of national treatment. Levying customs duty is not a violation of principle of national treatment because custom duties are levied before the product is entering into the domestic territory. Before the product is entering into the domestic territory. Okay, so that is basically principle of national treatment. Now, when a principle of most favored nation, it means all the countries in WTO, there is nothing like a most favored nation. So most favored nation, so if India has given MFN status to Pakistan, it means India treats Pakistan on similar lines as it is going to treat all other countries. India is not going to alienate Pakistan just because Pakistan is an enemy nation. Just because Pakistan is an enemy nation, India is not going to alienate Pakistan. Okay, so that is basically MFN, most favored nation. After Pulwama attack, India has revoked MFN status to Pakistan. But otherwise, India has given MFN status to Pakistan way in 1995. Pakistan did not give MFN status to India. That's a different thing. Okay, they are different people. Okay, and we are also not bothered about Pakistan not giving MFN status because we don't do much trade with Pakistan. Okay, so are there any exceptions to MFN? Yes. Bilateral agreements which India signs with other countries, it's an exception. Suppose India and Sri Lanka have signed a bilateral agreement, free trade agreement. That means duties and tariffs will be less between India and Sri Lanka only. That will not be applicable to all other countries. Okay, so that is basically an exception. Similarly, RCEP or SAFTA, South Asian Free Trade Agreement, or we talk about SAARC nations or NAFTA, these are basically trading blocks. They have their own regional groupings. So they may follow their own tariff lines. That will not be part of the MFN. So these are all exceptions with respect to most favored. These are exceptions with respect to MFN, most favored nation. I hope it is clear. Okay. So principles only those two. Okay. Then when it comes to agreements, the first agreement, most important agreement is TRIPS. TRIPS is basically related to intellectual property rights. So when we talk about TRIPS, okay, so TRIPS mainly focuses on two aspects. One is converting process patents into product patents, mainly with respect to food, chemicals, and pharma. Second, expanding the scope of intellectual property rights, covering patents, copyrights, trademarks, geographical indicators, industrial designs, trade secrets, all that. Okay, so widening the scope. Though this TRIPS agreement had to be implemented by the developed countries by 2000, developing countries like India by 2005, that is 10 years from formation of WTO, and least developed countries by 2016 and few things by 2023. So this is basically, we call it a special and differentiated treatment concept under WTO. That is basically, though the agreement is same for everybody, there is an extended period of time that is given for implementation. Extended period of time that is given for implementation. Extended period of time that is given for implementation. Okay. Now India made changes to its 1970s Patents Act to bring it in line with the TRIPS agreement. But at the same time, India has added two safeguards under TRIPS, which is called as the compulsory licensing and parallel imports. Two safeguards. Okay, so compulsory license. So what is this compulsory license basically? So compulsory license is, if there is a health hazard, if there is some problem, etc., temporarily the government can override the patent and issue compulsory license to a local manufacturer to manufacture the generic form of the original drug. This is only for a temporary period. So it helps in manufacturing the generic. So the most famous case in this is the Nexavar, which is a cancer drug of Glivec. So Nexavar, it is called as Nexavar case. Okay. And parallel imports. Parallel import is, suppose without the consent of the patent holder, okay, a country is able to buy generic drugs from another country. Okay. So that is basically called as parallel imports without the consent. So parallel imports can be applicable only under two circumstances. One, the original patent holder was not ready to reduce the price, number one. Second is, in the domestic country, there are no local manufacturers who can manufacture the generic form, and then only you can import it from outside. So this is what is the condition for parallel imports. So with respect to TRIPS, you have to remember these things only. Okay. Then we have this agreement called GATS. So GATS is General Agreement on Trade in Services. So GATS agreement mainly divides services into four modes. Four modes. Okay. So mode 1 basically, mode 1 talks about cross-border supply of services where the commercial presence of the service provider is not required. Commercial presence of the service provider. Services, cross-border supply of services where the commercial presence of the service provider is not required. Okay. So example, distance learning, BPO services, distance learning, BPO. So all these distance learning, BPO services, all these are basically cross-border supply of services where commercial presence of the service provider is not required. Okay, so that is part of the mode 1. Okay. Mode 2 is services consumed abroad. Services consumed abroad. So services consumed abroad like education, okay, tourism, medical tourism, etc. This is mode 2. Services consumed abroad. Okay. Mode 3 is again cross-border supply of services where the commercial presence of the service provider is required. is required. Developed countries are good. For example, banking, restaurants, hotels. So these are cross-border supply of services where the commercial presence of the service provider is required. Mode 4 is basically movement of human capital. India is good with respect to mode 4, followed by mode 1. Followed by mode 1. Developed countries are good with respect to mode 3 and mode 2. Okay, so this is what you should remember. So human capital movement, etc., is part of mode 4. Okay, so developed countries were inclined towards mainly liberalizing mode 2 and 3, where they were good, mode 2, mode 3. And they were putting restrictions on mode 4. They were putting restrictions on mode 4. Okay, so that should be clear. Okay, so this is about the GATS agreement. So another important agreement that can come up in the format of prelims question is the TRIMS, trade related investment measures. So though this agreement focuses on investment, mainly the strength of this agreement is coming from the logic of or the concept of national treatment. Okay, and these TRIMS agreement is outrightly rejected. TRIMS agreement is outrightly rejected by the developing nations. After a lot of discussion, the TRIMS agreement landed up mainly into 4 main TRIMS, 4 main entities. What are the 4 main entities under? So one is the countries should not should not come up with this requirement on the foreign player, local content required. You should not force the foreign player that compulsorily they have to use local content material for production, etc. Similarly, there should not be any restriction with respect to trade balancing. There should not be any restriction with respect to trade balancing. So that means if you want to use imported raw material, compulsorily you have to export a certain portion of it. You only balance the trade. Such kind of restriction should also not be there. 3, there should not be any export restrictions on the foreign player. If he wants to export, he will export. You should not put any restriction on them. Okay. Then 4, there should not be any forex restriction. No forex restriction. So if you want availability of foreign exchange should be there. Okay. So TRIMS basically, for developed countries, the TRIMS have to be implemented within 2 years. And for developing countries, it was 5 years. And LDC, it was 7 years. Of course, it was not followed. Developed countries had to implement TRIMS by 2 years. Developing countries by 5. And LDCs, least developed countries, by 7. But it was not adhered. It was not adhered, not followed. Okay. So this is what is this agreement called as TRIMS. Okay, and the next most important agreement is agreement on agriculture. Okay, this was an agreement, after a lot of lobbying, etc. Because countries like US give 19 to 20 times more subsidy than India, and they say our subsidies are non-trade distorting. But India, your subsidies are trade distorting. They are distorting the trade. Your subsidies are trade distorting. You are distorting the trade. Okay. So after mainly US gives production-based subsidies and India gives mainly product-based subsidies, and that is one big challenge. And product-based subsidies are seen as trade distorting. Product-based subsidies are those which affect the current production level. Okay, like MSP, etc. Okay, so after a lot of discussion, okay, agreement on agriculture mainly covers 3 important aspects. One is reduction in domestic subsidy. Reduction in domestic subsidy. Okay, 2, reduction in export subsidy. Reduction of export subsidy. Okay, so reduction of domestic subsidy, reduction of export subsidy, and also free trade or improved market access. Free trade or improved market access. free trade or improved market access. Okay, so domestic subsidy, under domestic subsidy, it is mainly divided into three different boxes: amber box, green box, and blue box. All these three are part of domestic subsidy only. All trade distorting subsidies are made part of amber box. All trade distorting. And since they are trade distorting, there is an upper limit which is maintained, upper limit. All trade distorting subsidies are made part of amber box. And therefore, there is an upper limit that is pushed, upper limit. Okay, so that upper limit is something that is beyond which you should not give. And that is called as the de minimis level of subsidy. So, the de minimis level of subsidy for the developed countries, de minimis level of subsidy for the developed countries is 5% of the production cost. And de minimis level for the developing countries is 10% of the production cost. Okay, so MSP and all these subsidies basically are part of the amber box. Then green box, these subsidies are considered completely non-trade distorting. Okay, and therefore it is excluded from all the reduction commitments. How much ever you want, you give. And developed countries are mainly interested in giving green box subsidies only. So fixed payments, whatever fixed payments that are given for environmental programs, go green, etc. Okay, protection of plant and animal, rural infrastructure development, all these are green box subsidies which are seen as completely non-trade. Blue box subsidies are an exception, that something related to production should be trade distorting. So basically blue box are also seen as non-trade distorting only, but blue box subsidies are production limiting subsidies. Production limiting. That means subsidies are given mainly to limit the production. Subsidies are given mainly to limit the production, and they are called as the production limiting subsidies. Then comes up the reduction in export subsidy. So when I say export subsidies, these are subsidies given to increase the exports. With respect to this reduction in export subsidy, there was some consensus in the Nairobi Ministerial Conference, that is the 10th Ministerial Conference in 2015. So Nairobi Ministerial Conference, the developed countries have accepted to remove export subsidy with immediate effect. And developing countries like India said, we will also remove export subsidy with respect to agriculture by 2019. But maybe with respect to few aspects like marketing, etc., we will extend it to 2023. So there was some consensus in the Nairobi Ministerial Conference with respect to export subsidy. Okay, so that is what we have to remember. Okay, so here, of course, these numbers are not important. Just I'm mentioning, they will not ask. Okay, so export subsidy has to be reduced by 30% by value. Not required, just for, it should be reduced by 30% by value or 22% by volume. Sorry, 21% by volume. Okay, so this is over a period of 6 years. Over a period of 6 years. Okay, this is basically for the developed countries. And for developing countries, now this is not valid because they've accepted to remove it completely in Nairobi Ministerial Conference. Amber box subsidies subjected, yes, amber box subsidies are subjected to reduction commitment, obviously. The de minimis level and all is amber box only, since it is trade distorting. So amber box subsidies are subjected to reduction commitment, because amber box subsidies you should not give beyond the de minimis level of subsidy. If you give it beyond de minimis level of subsidy, you should adhere to the aggregate measure of support reduction commitments under WTO. Okay, yes, amber box subsidies are subjected to reduction commitments. Green box subsidies are not subjected to reduction commitment. Okay, Yes. So that was the doubt. So developing countries, basically, developing countries, 24% by value, not required, just for info, just for info. 14% by volume. Okay. And this is within a span of 10 years. Okay. So that is like that they have said. But export subsidy, some conclusion came up in the Nairobi Ministerial Conference. Okay. Then improved market access, excessive. So simple logic of improved market access. Convert non-tariff barriers into tariff and over a period of time even reduce these tariff barriers. Convert non-tariff barriers into tariff and over a period of time even reduce the tariff barriers also. Okay, so here the tariff line has to be reduced by 36% in 6 years for developed countries, and for developing countries 24% in 10 years. Okay, that is how the tariff lines have to be reduced. Okay, tariff lines have to be reduced, 36% in 6 and 24% in 10. Of course, those numbers also will not be asked. Those numbers will not be asked, just an understanding. So mainly de minimis, amber, blue, green, question may come. That area, mostly in prelims. Okay, so that should be clear. Okay, so when we talk about the ministerial conferences, okay, so the first ministerial conference, okay, the first ministerial conference is Singapore Ministerial Conference, of course, Singapore Okay, so in the Singapore Ministerial Conference, what was the main focus? Okay, the main focus in Singapore Ministerial Conference, whatever that was discussed in the Singapore Ministerial Conference was also called as the Singapore issues. Singapore issues. So in the 1996, so Singapore Ministerial Conference mainly focused on 4 major issues, which is called as the Singapore issues. So one is, you can observe the chart. Okay, transparency in government procurement, fair competition, trade and investment, trade facilitation. So these are the 4 components: government procurement, trade facilitation, trade and investment, trade and competition. Okay, that's all. So this is what is Singapore issues. Of course, there was one more thing that was visible in the Singapore Ministerial Conference, which is called as the green room mechanism. So green room mechanism means closed WTO members were called and they were discussing things among themselves. Okay. Then Doha Ministerial Conference was one of the most important ministerial conference. So I made you write some notes also. So Doha Ministerial Conference was also called as Doha Development Agenda. So why it was called as Doha Development Agenda is obviously because there were certain things that were discussed in the Doha round, which were useful for the developing nations, useful for the developing countries, and therefore it was called as the Doha Development Agenda. Okay, and what were the things that came up in the Doha round? Okay, so if you are referring the notes, with respect to Doha round, agriculture is one. Okay, so there was this special safeguard mechanism discussion. So if there is a sudden import surge or there is a sudden price fall, okay, so you can come up with these special safeguards. This special safeguard mechanism was approved again in the Nairobi Ministerial Conference, 2015. But in the Doha round, there was discussion of special safeguard mechanism. Then with respect to agriculture, one more observation is, developed countries said we will reduce agricultural tariffs provided you reduce your tariff lines with respect to NAMA products. NAMA, non-agricultural market access. So NAMA is mainly manufacturing products, forestry, oil. Okay, so NAMA products are very important for global merchandise trade. Why? Because NAMA products, more than 80% of the goods trade are mainly NAMA products only. Okay, so the US was saying, you reduce your tariff lines with respect to these products, then we will reduce our tariff lines. So this was also there. Then US was also asking countries like India to reduce the number of import sensitive items. Import sensitive items. What are import sensitive? If you import beyond a particular level, it will create problems. So that was also mentioned, and reduce the number of special products and import sensitive. So India, we have this in WTO, there is a self-designation of special products. So India, it will name rice as a special product, wheat as a special product, self-designation. So, and you can come up with special safeguards to protect them. So when we say special safeguard, these are of particular importance to the country, maybe because of issues like food security, etc. So once you designate it as special product, now you can come up with some restrictions of trade. That US did not like. US said you reduce the number of special products and import sensitive items. So India also said TRIPS, no, under TRIPS you are only covering wine and spirit, no, extend it to other products also. That was also discussed. No? Just TRIPS agreement, you are restricting it to wine and spirit. So in the TRIPS agreement, there was also the geographical indicator stated, not only wines, for others also, you extended. Then NAMA and special safeguard mechanism. So India was asking for something like, India took a middle path. Okay, so India was obviously supporting the special safeguard mechanism. Okay, and India wants a permanent solution with respect to public stock holding. Okay, public stock holding for the developing countries. So no solution came up in the public stock holding. Some solution with respect to public stock holding came up in the Bali Ministerial Conference. Bali Ministerial Conference 2013. Okay, so this is about the Doha round, which is also called as the Doha Development Agenda. So Bali Ministerial Conference is the 9th round. Okay, so mainly Bali Ministerial Conference, you have mainly 3 important entities. So Bali Ministerial, it is also called as the Bali Package. So in 2013. So one important thing which is important for prelims is, in the Bali Ministerial Conference, they arrived at something called as the Peace Clause. Peace Clause. So what is this Peace Clause? It was a temporary relief till 2017. Temporary relief. What is this temporary relief? If India is going to cross its de minimis level of subsidy, or any other country is cross, you will not take them to the dispute settlement body. Why it is important for India in 2013 is, in 2013 there is National Food Security Act. So this National Food Security Act 2013 basically wanted to cover 67% of the population. So when you are covering 67% of the population, India was about to cross its de minimis level of subsidy under amber box. So any other country, especially the developed country, can take India to the dispute settlement body. So we were asking for a solution. Though we did not get a permanent solution with respect to public stock holding, we got a temporary relief. So what was the temporary relief is? Temporary relief was something like in the form of peace clause. What is this peace clause? Till 2017. Okay. If you cross the de minimis level of subsidy also, we will not take you to the dispute settlement body. That is what. Okay. So one was peace clause. That means public stock holding, food stock holding. This led to peace clause. Okay. Then India supported, there was this trade facilitation agreement to cut down red tape and custom clearances, single window clearance. And LDC exports. India was always supporting duty-free and quota-free. The DFQF is duty-free and quota-free market access to LDC exports. So this is what is called as the Bali package. Okay. Then Nairobi Ministerial Conference 2015. Okay. So this is the last one we will discuss today. And then the Geneva part and the other topics we can start tomorrow. So Nairobi Ministerial Conference, basically, they arrived at Nairobi package. Okay, so what did they discuss in Nairobi Ministerial Conference? So here you can observe, one is the special safeguard mechanisms. That was, then India was expecting a permanent solution with respect to public stock holding. Okay, why? Because the temporary relief was only till 2017. Okay, so we were expecting a permanent solution with respect to public stock holding. Okay, in this Nairobi Ministerial Conference, India was cornered by developed countries as well as developing countries. So developed countries were saying, India, you are, uh, they came up, basically developed countries, they wanted to revitalize the WTO. Revitalize, they came up with new issues. So new issues they brought in without resolving the old ones. Developing countries were saying, India, you are not a developing nation, you are an emerging economy, so don't take the benefits and all that. So like this, India was cornered from both the sides. India was cornered from both the sides. Okay, so somebody has switched on something. Okay, so here India was cornered from both the sides. Okay, so here what were the new issues basically? So new issues is, one is e-commerce, then labor and environmental standards, etc. Transparency in government procurement, supply chain management, all these were new issues that were brought in, okay, so during the Nairobi Ministerial Conference. Okay, and India was very clear in the Nairobi Ministerial Conference. India was saying, we will not sign any binding agreements whatsoever. No binding agreements will be signed whatsoever when we are with respect to new issues. And India was very clear. It said, you are saying new issues. No, if you want to add any new issue, include human capital. Movement of human capital should be the new issue, not this. This is not the new issue basically. Okay, and export subsidies with respect to agriculture, there was some solution, and also special safeguard mechanisms, SSM, there was some solution in the Nairobi Ministerial Conference. Okay, so Buenos Aires ended up 2017 Ministerial Conference ended up without any ministerial declaration. Remember, Buenos Aires is not first ministerial conference which ended without ministerial. Earlier also there were ministerial conferences which ended without signing of ministerial declarations. Okay, so that is something which we have to remember. And nothing significant happened in Buenos Aires except some fisheries related discussions, fisheries subsidies, e-commerce, etc. Okay, so one ministerial conference that is left, which we will continue tomorrow, that is Geneva Ministerial Conference. And Geneva Ministerial Conference, and then we will get into capital markets. We'll discuss capital markets, and then external sector. We'll discuss agriculture. Okay, so and growth and development, that is poverty, unemployment, etc. So these things we will discuss tomorrow. Okay, that's all. So I hope I have not wasted your time, because I'm very, very critical when I'm doing these rapid revisions. I feel that, something should come, because before exam, when we are spending time, that time should be very much productive. Okay, so WTO, much questions were, the economic survey part, WTO you will not have. So again, economic survey part, tomorrow I will discuss this, agriculture, food processing, what was stated in the budget and all. So tomorrow, those will be important for exam. Okay, so I hope you have understood. Yes. And hope you have revised well, because spent some 6 hours. Okay, so, and tomorrow, remaining parts of survey and budget I will complete. Remaining means I will try my level best to put whatever can come. But it is my observation and expectation only. 90% it will go right. But sometimes he will ask some question, but which nobody will answer. That's okay. Okay, so that's all for today. Signing off, man. Thank you.